inflation is not coming down as fast as we expected?
Inflation just has stopped going down. It's stalled at a level that's uncomfortable for the Fed.
They're going to want to be more patient. Inflation is going to be top of mind.
I think the clear part of the new narrative is high for long on rates. The question is, where does that take us?
You can't keep rates up here forever. The Fed's going to start to cut, and you're going to have a massive rally.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This is a proper Monday morning. So Bramo's out, long weekend. AMH partied too hard, can barely speak.
No.
What time do you go to bed Saturday?
Around 1:30.
That sounds like 3:30. That sounds like a 3:30 voice. We'll get to AMH a little bit later in the show, if she can actually speak. Live from New York City this morning. Good morning for our audience worldwide. Let's get your week started. Equity futures positive by 0.1% on the S&P 500. What a week ahead we've got for you. Here's your top four. Tomorrow, earnings from Amazon. Then on to the Federal Reserve on Wednesday, decision day, a news conference with Chairman Powell. Apple earnings coming on Thursday, payrolls on Friday. If you want a sneak peek of Friday, the estimate in our survey, 250K. And as you all know, payrolls has been absolutely dominated by a series of upside surprises. This morning, dominated by one chart. It's dollar yen. Can we throw up dollar yen and can we talk about the range we've seen on dollar yen today? This is not a monthly range. This is an intraday range. We've been through 160 already in the last 12 hours. Dollar yen back down to 155.76. We've had a break of 160 for the first time in more than 30 years. We started the month focused on 152. 152 they wish at this point, and they being the Ministry of Finance in Japan, no comment. That's what we heard from the Ministry of Finance, no comment.
No, it was no comment for now. So what they're doing is they're being very fuzzy about what's going on. People are talking about potentially, was this a fat finger? Was it the fact that there's a public holiday in Japan, low liquidity? But I love the fact that they come out and the top currency official says no comment for now. Will we get a comment? Did they intervene? We don't know.
I think that was a comment. It's just sort of like no comment. For now, apparently. If you wanted to make a statement, it's a great time to do it. AMH just said, low liquidity, national holiday, it makes a whole lot of sense. This is what Mizuho said. Will a dog chase an airborne frisbee? This is helpful. Yes, markets appear to be trying to push dollar yen towards 160 in the absence of official intervention, and it's still unclear whether we've had so-called intervention. Kit Jukes at SocGen really putting forward, I think, the statement of the morning. What we actually need to see to put a durable floor, or rather durable ceiling, on top of dollar yen. This is what Kit has to say. More aggressive policy action from both the Ministry of Finance, concerted and repeated intervention, and the BOJ, signalling a willingness to normalise policy further, are necessary to stabilise the currency, and clearer signs of stronger growth across the wider economy, as well as signs that Treasury yields have peaked, will be needed before a sustainable yen rally can actually get going. That's the pushback from Kit this morning. That currency pair has been an absolute mess so far in April. 155.74 is where we trade. Coming up this hour, fantastic lineup to get through a week of events for you. Laurie Calver-Senior of RBC as stocks rally ahead of earnings from Amazon and Apple. Mark McCormick at TD Securities as the yen bounces off a 34-year low. And Wells Fargo's Jay Bryson looking ahead to the Fed and US payrolls. We begin with our top story. US stocks coming off their strongest week of gains so far this year, thanks to a big boost from big tech. Laurie Calver-Senior of RBC writing this. We still believe our year-end S&P 500 target of 5,300 is a reasonable expectation. The key thing we've learned from our survey is that even though higher rates are a headwind, there's a confidence in the stock-picking community that this challenge can be managed. Laurie's with us for the hour. She joins us around the table. Laurie, good morning to you.
Thanks for having me.
Fantastic to see you. I want to start with this. This came from Peter Chiv Academy, and he went through some of the big names in big tech over the last week, and he started with NVIDIA 2 Fridays ago. So 2 Fridays ago, we had a 10% move on absolutely nothing. A $2 trillion company, 10% move just like that. Tesla, last Wednesday, a move of 10% on a $500 billion market cap. Meta, another move of 10%, this time to the downside, on a $1 trillion market cap. And then we had Alphabet with a move of 10% on Friday on a $2.1 trillion market cap. Peter Chiv asking the big question, is 10% the new 1% for mega cap tech, and what's the message you take away from that?
So I'll go back to my small cap days if I can, and I know these are the farthest.
That's what it feels like.
Yeah, this is how small caps have always traded. I think some of the price reactions in small cap to prints have gotten a bit worse than that, but I think in small cap this is just something that was a normal sort of reaction to earnings for a long time. So it doesn't maybe throw me quite as much as it might some other folks.
What should we take away from the fact that uber cap stocks are behaving like small caps though?
Well, I think what we're seeing, if we look at the earnings data, and Bloomberg does some great work just forecasting where the earnings are expected to go based on bottom-up consensus forecasts. We've been talking about this since January, and you see a decelerating growth rate. So coming off around, I think, 35% in 2023, if you look at the basket as a whole for the Mag 7, that's forecasted to drop to about 15% or so in 2025, and really basically come in line with the rest of the market. And there's one thing I've learned over the course of my career is that when you have these, powerful momentum stocks and growth rates decelerate, it doesn't matter how good the growth is. Growth investors get angsty, and that's what I feel like you're seeing in the stock price reaction.
It raises big questions right now about what's being rewarded and what's being punished. Going into numbers from Apple and Amazon, we talked about the dates for those two names. Amazon earnings coming tomorrow, Apple coming on Thursday. Can we focus on that a little bit more? What do you sense has been rewarded really well this earnings season? What's getting punished?
So if you look at the Russell 1000, and we have to look that big at this early in reporting season, the beats aren't getting rewarded. I mean, they're underperforming. They're not performing as well as they typically do in kind of the 1 to 2 day post prints. So I think what I've noticed as we're going through commentary, and again, it's still very early. We're reading as much as we can. We don't get through everything. They're fast reads. But what I feel like I'm seeing is just kind of an intolerance for the we need to be patient conversation. We sensed a lot of that early on. I sort of felt like there was a shift last week, kind of midweek, where companies who were saying, okay, we're getting the benefit of these things now, and I'm thinking about specifically on the AI discussion, we're benefiting from the ramp that's going to continue in coming years. Investors were okay with that, but the sort of wait and see, this is going to take time. Again, we've got decelerating earnings growth at, kind of 27 times multiples on a median PE in those biggest tech stocks. Investors just don't have a lot of patience for that right now.
So is there time for a pullback now?
So we've been getting a little bit of a pullback, and a lot of that has happened as we've had some volatility in these bigger names. Look, I'm not looking for any kind of massive pullback in those names or massive pullback in the markets. We've said we thought the pullback would be worth about 5 to 10%. We've had more than 5. I don't think we're quite done yet. If you look at CFTC data on positioning in either NASDAQ 100 futures, S&P futures, or the broader market, we haven't even begun the correction. If you look at AAII, we've done some damage, but we've still got, probably at least a couple more weeks of damage to do there.
So if you look at the Peter Cheer note, and he talks about how all these big companies are trading like little companies, who's going to be leading? If there's not a pullback right now, how do you see this rotation?
So, I think the financials have come through this reporting season so far reasonably well. I personally on my team read a lot of industrials and materials. I'm not really seeing any big kind of demand problems. I'm seeing companies that are talking a lot of being able to manage through headwinds. I think it's not so much a particular sector. I think it's looking for industries, for companies within the value cyclical cohort of the market. So that could be energy, materials, industrials, I think certain small caps as well.
I want to talk about another big Uber cap company, Apple, on Thursday. This from Bernstein this morning. Latest note dropping from them. Buy the fear. Upgrading the stock to outperform. Apple is derated significantly amid a weak iPhone 15 cycle and fears that Apple's China business is structurally impaired. They're taking the other side of some of this, Laurie. I won't ask you specifically about Apple, but maybe some of the forces associated with that name at the moment, the difficulty navigating international waters, particularly China, the strength of the US dollar, a factor, I think, as well. I was reading through your note overnight. How many times have those two themes come up on earnings calls so far?
So the FX headwinds are coming up. I'm noticing it more with the tech companies, to be honest, than others. And we'll see, we've got a lot of stuff in the other parts of the market to hear from, but so far it seems mostly to be a tech company phenomenon. I will say on the geographic commentary, and it's maybe a little hard to say because we've had a lot of financials so far, but at least in what I read last week, the geographic commentary, so Europe, China, kind of trends versus the US, things seem a lot more balanced. Whereas if you look last year, it was all China's not coming through as well as we anticipated. There's a lot of uncertainty. Things haven't bottomed yet. And I wouldn't say I'm seeing a lot of, jumping up and down and celebrating on China, but it just seems more balanced.
What do you think the difficulty has been in China for tech firms specifically? What is unique about China to them?
I'm not sure I know the great answer to that question, to be honest. I know it's been a growth part of the business for many of these companies. And when you're encountering, sort of difficulty in the post-pandemic world, there was so much excitement a year ago that we were sort of finally getting that recovery and that normalization. And that normalization, I think, just hasn't been as clean as a lot of companies would have anticipated. I think there's just not a lot of visibility necessarily on when that was going to turn around.
When you read through these earnings reports, I think back to what Mohamed El-Erian recently told us about how a lot of people missed what CEOs were saying and they bought into this transitory inflation, but CEOs were saying, actually, we still feel inflation coming down the pipeline. What do you gather from reading all these reports about where inflation is right now for these corporates?
So, it's funny. Back in the last reporting season, so kind of calendar 1Q for the 4Q numbers, companies were raising the red flag, right? Like they were really complaining about costs, margin pressures. I'm not sensing quite as much of that now. It doesn't sound good. It sounds, some companies are complaining a lot about inflation. Some people are talking about moderating, disinflation, deflation. It's a little more mixed, but again, it is still very early.
Laurie, this was great. It's going to be fantastic to run through some of the top stories. 10-minute conversation with Laurie Calver, senior of RBC. Not a single mention of the Federal Reserve going into that decision on Wednesday, which I guess is a good thing because we've actually been talking about nothing but the Federal Reserve over the last month or so. Let's turn to the price action. Let's get the cross-asset board up and start with equities. Equity futures on the S&P 500 positive here by 0.1%. That move has been fading through this morning. So we're near session lows on the S&P 500. In the bond market, yields are lower by 3 or 4 basis points on a 10-year, 462.39. And in foreign exchange, the euro a little bit firmer here. Dollar yen turning around big time. We'll talk more about that a little bit later. The euro 107.15, that currency pair positive by 0.2% of 1%. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Elon Musk's quick visit to China has paid off almost immediately. Tesla now has cleared 2 key hurdles for its driver assistance system. Tesla will be partnering with Baidu for mapping and navigation to support its full self-driving function, sources say. I spoke to Saxo's Peter Gardner earlier this morning, who told me that Musk's visit to China was an acknowledgement that he needs to change the market narrative, but ultimately, Tesla still won't be a top player in China's EV market. Philips shares soaring in the European session this morning, up 46%. The company reached a lower than expected settlement on U.S. claims over faulty sleep apnea devices. The deal they reached with authorities was for $1.1 billion. That compares to what analysts were expecting of $4.5 billion. The expectation is also that this will draw a line under U.S. claims, but Philips, for their part, are still conducting toxicology tests related to the devices. Now, the Redstone family and David Ellison are trying to appease angry Paramount investors. Sources tell us that the Redstone family, which controls a majority of shares, and Ellison of Skydance are both making appeals and concessions. Ellison is offering to buy a block of Paramount shares at a premium. His bid described as the, quote, best and final offer, as board members remain undecided about a Skydance takeover. CEO Bob Bakish could be ousted as soon as today by a management committee. That's your Bloomberg Brief. John.
Danny, appreciate the update. That story's been an absolute mess over the last few weeks. Look out for updates on that. Got updates on this from the World Economic Forum Summit being held in Riyadh, Saudi Arabia. Secretary Blinken's been speaking in the last few minutes, saying this: the Israel ceasefire proposal, he calls it, quote, extraordinarily generous. Hamas is the only thing standing between a ceasefire in Gaza. That's the latest from Secretary Blinken this morning. I imagine we'll get more headlines throughout today. Up next on the programme, the 2024 presidential race ramping up.
The 2024 election is in full swing. And yes, age is an issue. I'm a grown man running against a 6-year-old.
That conversation just around the corner. Live from New York City this morning, from a beautiful New York. Good morning.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Equity futures on the S&P 500 positive hit by 0.1%. Last week, the biggest weekly gain on the S&P 500 of the year so far. Just remember that followed the biggest weekly loss on the S&P 500 of the year so far. In April, we're still down about 3%. In the bond market, yields are lower by 3 or 4 basis points, 462.59. Two big events this week outside of earnings. Federal Reserve Wednesday, payrolls report on Friday. Under surveillance this morning, the 2024 presidential race ramping up.
The 2024 election is in full swing. And yes, age is an issue. I'm a grown man running against a 6-year-old. Well, I feel great I really feel great. I'm campaigning all over the country. Pennsylvania, Georgia, North Carolina. I've always done well in the original 13 colonies.
The President of the United States over the weekend. Just a few things to say. I know the President likes ice cream, so let's run with that theme. If you order vanilla and you get vanilla, you can't complain after that. If you get a vanilla comedian to do the so-called grilling and you get a vanilla grilling, what's the complaint? Who was surprised? I mean, I like the guy. He's very pleasing just to listen to. What's the surprise? He's a vanilla comedian on SNL and he delivered vanilla.
He had some funny moments, but at the end he almost endorsed the president when he talked about his grandfather who voted for Joe Biden, and he explained this whole story saying that he thinks he's a decent man. And that's not really the job of the comedian. The comedian is there to roast the administration and the journalists in the room. Goes both ways. And maybe he was just too friendly.
Shane Gillis. Can we just book Shane Gillis for next year? Just get it done, a proper roasting from Shane. Wouldn't everyone love that?
It would be pretty funny.
That would be pretty funny. That would be better than good. Here's the latest this morning. New polling from CBS in 3 swing states showing President Biden with a single-digit lead in Michigan. Former President Donald Trump with a slim lead in Pennsylvania and Wisconsin. Terry Haynes of Pangea Policy writing this. Biden is still likely to be re-elected by the skin of his teeth. Polls are levelling out. Trump is still weak. And RFK's balloon is punctured and slowly running out of air. Terry joins us now for more. Terry, wonderful to have you with us on the programme this morning. You've maintained this view for quite a while. What is it that you see in our future that ultimately ends at this destination?
Well, fundamentally, it's that Trump is kind of topped out, and Biden's got a floor, and with some room to run and room to grow, and that's fundamental. Trump is ever since mid-January, Trump's been awfully weak. What you've got is you've got splits. You saw this in the primaries. You've got splits of 20 to 40% of the party regulars not voting for him. You've got independents not breaking his way. He needs a unified party, and he needs independents to be more for him than not in order to win. Right now, that's not happening. You combine that with an electorate that really hungers for a credible, serious third-party candidate. For a while, it looked like you'd either have Bob Kennedy or a no-labels candidate, or both in those shoes. No labels dropped out for a lack of ability to convince anyone, and Bob Kennedy, I'm sorry to say, has made his candidacy into a niche one and far less serious. So what you got here is you got a situation where Biden, I think, is going to have a superior organization, superior get out the vote, and 6 months from now, I think that's what you see is the skin of the teeth win.
Terry, you know the cheat code for amateur political pundits like me. You turn around, you bang the table and you say, it's all going to be about turnout. It's all going to be about turnout. And Terry, you just say that and repeat to try and sound smart. Terry, can you tell us about turnout, the potential for people just not to turn up to the election in November, given how disappointed they are with the two candidates in front of them?
Yeah, I think there's possibility for that. It is all about turnout, of course, but at the same time, folks tend to overestimate how much turnout goes up or down. The famous Obama surge in 2008 turned out to be something like 1.7% of the electorate. And it seemed much bigger than that, even on the ground at the time. But what you've got here is a situation where you've got a couple of candidates that aren't actually exciting people, generally speaking. There was one joke factory called it a gesture to Earth Day by recycling presidential candidates. But that's going to get replaced, I think, by a surge by some on the right, kind of the Trump loyalists who haven't increased their numbers since 2020, but are still quite passionate. But you're going to have the social issue Democrats, particularly in swing states, and that's exactly what Biden's counting on. The third thing they'll count on is, as Jim Messina, Obama's former campaign manager, said, is driving third-party numbers through the floor in the next 6 months, and they'll try to achieve that too by making Kennedy into a nut.
Terry, this is Lori Calvasina. As you think about the polling data and just sort of Biden's low approval numbers, favorability, is there anything that can turn those around? In markets we're watching inflation, we're watching foreign policy. Do any of those things, matter for Biden's polling stats at this point?
Good morning, Lori. I think the way I would look at it is Biden's numbers are going to be Biden's numbers on favorability and all the rest are pretty much going to be what they are. I take issue with a lot of where the White House has been on a number of these issues, saying that you're going to deal with inflation and then, having people still dealing with high prices and unsatisfied is not exactly a smart political strategy, among other things. But, what I tend to look for is not so much whether or not his numbers on favorability, likability, anything else go. Another amateur table pounder is always, it's always a choice, right? Whether you're choosing for somebody or against somebody. Biden's gambit is going to be that he's going to make it not so much about him. He's going to have a record, but he's going to make it about the other guy. And, what you saw at the Correspondents' Dinner, you're going to be treated to 6 months more of that as part of that strategy. And I think that, wanting less of the Trump circus is part of the Biden campaign strategy. I think it actually helps him.
And Terry, one more, just as we think about the intersection of politics and markets, when you're thinking about policy from these two candidates, what are the one or two things you're saying if Trump wins or Biden wins, investors should really be expecting to happen in terms of trades they can make?
Well, I'm not going to recommend specific trades, but what I will say is that you've got a situation where, Trump's going to be stronger on kind of traditional, traditional industries and sectors, defense, fossil fuels, things like that, generally speaking. There will be a lighter hand regulatorily, none of this foolishness coming out of the FTC, trying to have antitrust cases against luxury handbag makers and the like. So, so that will cheer markets. What will worry markets about Trump, frankly, is the kind of stuff that's coming out of hyperventilating staff these days, trying to meddle in the Fed independence, that sort of thing. Anything that meddles with the fundamentals of markets, and that includes the Fed's ability to do its job, is going to be a negative for markets. And, that's happening now a little bit. But I think should Trump be president, markets will very much need to look out for that.
Terry, I want to go back to the CBS News poll. Biden and Trump are neck and neck when it comes to the blue wall. What levers can Biden pull before the election to help these three states shore up support? Michigan, Pennsylvania, and Wisconsin.
So let me speak to Pennsylvania specifically because I know the most about it in a granular sense. Biden thinks he goes to Philadelphia, he's going to Pennsylvania. That's not true. There's Philadelphia, then there's the vast rest of the state. The vast rest of the state is, speaking broadly, is red. They don't like him. They don't understand what he's doing. What they understand is that their prices are up and their core industries, including energy industries, LNG and the like, are under attack. Biden needs to do more than get into Pittsburgh, let's say, and talk to the steelworkers for 15 minutes. He needs to go 15 miles south to Cannonsburg, which is the world capital of fracking, essentially, and talk to people in Washington County, Greene County, Fayette County about why he's trying to do what he's trying to do for them. It can't just be about the groups that in kind of traditional Democratic politics, the groups in which you get turnout. It's got to be about more than that. The more he actually tries to connect with real citizens who might be skeptical about him, the better he'll do. And that's going to be key in a place like Pennsylvania.
Terry, I've got 10 seconds. Should Saturday's dinner be the last dinner?
It should have been the last dinner about 10 or 15 years ago. All I have to say to you is, look to Jerry Seinfeld's great quote about the death of comedy, and you'd see everything you need to see in that dinner.
It died on Saturday night. Terry Haynes of Pangea Policy. That's brutal. Sound like the New York Times. Terry, thank you, sir. They had a brutal review of Saturday night. I didn't think it was that bad until the very end. I'm not sure I'm interested in which way he thinks we should vote. But anyway, this from DJ, Dow Jones. Japan financial authorities did intervene in the FX market. That's the report coming from sources, according to Dow Jones today. The official on-the-record point of view from the Ministry of Finances, no comment. This is the story coming out of Dow Jones. Dollar yen with a big swing, breaking through 160 overnight, back down to 155.85. We'll catch up with Mark McCormick at TD Securities up next. From New York, this is Bloomberg. Welcome to the program. Sneak peek of summer a little bit later today in New York City. Wishing you all the best for the week ahead. Equity futures on the S&P 500. It's going to be a warm one here in New York on the East Coast. Equity futures positive by 0.1% on the S&P, on the Nasdaq up by 0.2%. Really strong week of gains in the equity market last week. Strongest week of gains we've had so far in 2024. If you switch at the board and get to the bond market, 2-year and 10-year. Let's focus on the 10-year. We've had 5 weeks. 5 weeks of the 10-year yield climbing higher. A little bit lower this morning, down 4 basis points. Last week, briefly, through 470. 462.39 on 10s. On 2s, 497, just in and around 5% over the last few weeks or so. If you turn the board and turn to foreign exchange, the only thing we're talking about today in foreign exchange is what is happening with dollar yen. So let's go through the range together on dollar yen. Overnight, late last night, US time, we broke through 160. So the higher the session, 160.17. The lower the session, 154.54. And the price right now, 155.83. The official line so far from the Ministry of Finance in Japan is no comment at the moment. This is coming from Dow Jones just moments ago, that Japanese financial authorities did intervene in the FX market overnight. There was a public holiday, low liquidity, really the perfect time in either direction if you wanted to bully the Japanese yen, in either direction. So what we saw was dollar yen gap higher, and then ultimately, potentially, reportedly, authorities coming out and pushing this one back down again. Big week ahead for this foreign exchange market, with the Federal Reserve on deck on Wednesday and payrolls on Friday. Under surveillance this morning, the latest Fed decision and news conference from Fed Chair Jay Powell coming on Wednesday. Investors looking for a hawkish tilt after a string of hotter than expected inflation prints. US payrolls rounding out the week on Friday. Bloomberg survey, the median estimate, 250K. 250K does not scream recession. The previous month doesn't scream recession either. It screams boom. 303 was the previous month. We're looking for 250 in the number on Friday. Laurie Calvasina of RBC with us around the table for the rest of the hour. Laurie, let's talk about the Federal Reserve. We haven't mentioned it yet. Wednesday, what are you and the team looking for?
So, look, I feel like the equity community has already gotten into its head, at least a decent number of people I talk to, that cuts aren't going to happen this year, right? And that's not necessarily what you're seeing in market pricing, but I've been hearing this since February, right? So I have a hard time sitting here with 166 companies coming out saying equity investors are really going to be focused on the press conference on Wednesday afternoon. Now, I know we always have a lot of drama around it. It always comes back. But to me, frankly, it's a little bit of the B plot this week. I'll be really kind of listening to see if there's anything the market takes out of it suggesting there might be hikes coming, because I do think that would be really disruptive to equity investors, but that's not something I'm really anticipating.
So given the choice right now in front of you, and we could go through the week ahead again, tomorrow Amazon, Thursday Apple, so that's earnings, data on Friday, the big one, payrolls. We've got some ISMs through the week as well.
Yeah.
Then you've got monetary policy, which you think is sort of like the B list this week. What's the A list? What's the number one for you?
The A list is just the earnings themselves, right? I mean, I think as long as we've got a reasonably strong economy, I think the market can handle the Fed just sort of staying steady. Now, admittedly, when I look at my valuation work, there is some downside potential if we don't get any cuts this year. We have a whole big model that looks at inflation, Fed, 10-year, PEs. We look at it against our earnings. There could be, some downside to, say, 4,900, 5,000. That doesn't feel good, but it's not exactly a disaster from where we're sitting today.
One thing that isn't steady in the pre-market is Tesla. Tesla rallying pretty hard. Here's the news on that. The CEO, Elon Musk, you might have noticed over the weekend, making a surprise trip to China. Bloomberg reporting the EV maker will partner with China's Baidu for mapping and navigation to support full self-driving in the country. The technology does not make the cars autonomous, but the software is sold for $8,000 or $99 a month. That stock, AMH, is up by 8.5, 8.6% this morning.
And this surprise visit, Dan Ives is calling it a home run by this visit by Elon Musk. They also seem to pass this key data security that they would need from Beijing in order to be able to use FSD in that market. It just goes to show how important China is for Elon Musk. He was supposed to have a sit down with Modi of India. That got pushed to the side, and yet his first trip, after a little bit of struggles, immediately to China.
Craig Trudell of Bloomberg joining us out of London on our latest reporting a little bit later this morning. Look out for that. I want to turn to the main event in foreign exchange. The yen bouncing off its weakest level in 34 years. Dollar yen falling to 160 before rallying back on thin trading due to a local public holiday. Japan's top currency officials saying no comment for now when asked by reporters if the government intervened. Mark McCormick at TD Securities joins us right now to comment officially on the situation. Mark McCormick, what happened overnight?
Yeah, I think it's pretty clear if you think of the sequence. We had some hot inflation data come through the last couple of weeks in the U.S. Then we basically had BOJ that was standing pat, basically said we're pretty much not changing our stance. We're not doing anything. I think one of the things is the BOJ is very good at telling us what they did historically, but I don't think you should look at the BOJ for forward guidance on what they'll do in the future. So dollar yen moved rapidly higher after those events. And essentially what you have is the BOJ and the Ministry of Finance seem to not have the same opinion about where the yen should be. And it looks as if overnight the Japanese officials had intervened in the FX market to try to strengthen the yen.
Mark, let's get into that distinction. It's important. So we've heard complaints from the Ministry of Finance. We've heard next to nothing from the Bank of Japan. We have to deal with the big question. Is it a problem or not? Do you think it is a problem?
Well, I think part of it is the problem is it speculative and does it have kind of somewhat of a negative impact? I think part of it with FX is there's always winners and losers. So, if you think about it from one perspective, the BOJ, they're helping tourism, they're helping profit margins. Those things are good. You can see the exporters are accumulating larger surpluses. But again, at the same time, if you look at the correlation to the whether or not the politics and the politicians are actually doing their job properly, I think what we can see is there's a very strong correlation with the disapproval rating in the diet versus the movement in dollar yen. So this is a big pain point for consumers. Also, if you look at oil based in yen prices, we're back to where we were in 2007, 2008. So there is a massive consumer shock here that's going on from the weakness in the yen. So I think the Ministry of Finance is more focused on the broad-based movement and whether or not it's kind of dislodged itself from fundamentals. And the BOJ is essentially just kind of sticking to their party line that this is not something that they want to control. They basically control interest rates and monetary policy, and the FX is basically a function for the Ministry of Finance.
This currency's been bullied all month. Mizuho describing it as a dog chasing an airborne frisbee, which made me laugh at least this morning, Mark, looking at the direction of travel over the last month or so. I want to know whether you believe we've actually put a sustainable ceiling now in this currency pair on dollar yen. And I want your opinion on this from Kit Jukes of SocGen, who said basically what we'd need to achieve that is more aggressive policy action from both the Ministry of Finance and from the BOJ. Then the BOJ would need to signal a willingness to normalise policy even further, which so far, Mark, as you know, they've been reluctant to do so. So do you think we've established a pretty durable, solid, resilient ceiling on dollar yen around 160?
I think we have, in part, on the fact that what intervention does is it doesn't change the trend. It changes the psychology. So, typically we could see is at least 2 weeks of this intervention working. I would say what we need on the other side is we do need to see the trajectory of the dollar change. We do need to see the fundamentals in U.S. change. I don't think that's going to change in favor of a stronger yen in the short term. But as you mentioned, the BOJ does have an impact. And, I think part of what, if we go back to like every major central bank when they started normalizing policy over the last couple of years, everyone chronically underestimated what the terminal rate was. And I think this was a part of it. It's price discovery. We're in a new world. Central banks are essentially their forward guidance and their forecasts themselves have not been able to articulate exactly where they think the terminal rate should be either. So it's been basically, the market has basically been forced to kind of go through this process of figuring it out through trial and error. And I think basically what we should think about is that the BOJ and the Japan policy rate, the natural policy rate is much higher than what's being priced in the markets. If you look at one year Japanese basis price swaps were basically around 50 basis points. I would argue it's much higher than that. It's probably above 1. So I think at some point, whether or not it's because of the currency or whether or not just because the level what's priced in the market and where inflation is a bit more sticky in Japan. If you look at some of the stuff that's dropped out of the inflation basket in Tokyo and some of the other indicators you track in Japan, they're more temporary. They're related to fiscal stimulus that's come through. They've come through on subsidies. So, but the level of inflation in Japan is generally pretty higher. So I would argue here that the BOJ is going to be forced to tighten more aggressively at what's priced in the market. That will help stabilize the yen. But for the process to turn lower, you just need a much more dovish Fed, which looks increasingly unlikely, at least for the remainder of this year.
Well, Mark, that's what I wanted to ask. If short term, the U.S. dollar is not going anywhere, won't the BOJ, the financial chiefs and the currency chiefs in Japan just be dealing with this episode again?
Well, I think a big component here is if you think about what drives dollar yen, I think there's two factors right now that we can kind of see in some of the models and data we track. It's hedge funds because there's a trade in it, and it's Japanese institutional investors. So I think a big piece of it is the market wants to see institutional investors kind of front run movements in the policy. And I would argue that they are lagging indicators. So if you think about pension funds, insurance companies, even corporations, essentially these are probably some of the institutions that are caught on the wrong side of this trade. I think a lot of these places were probably thinking between 140, 145, that's top in dollar yen. So a lot of these institutions were probably essentially short dollars, long yen, and basically the move to 160 just was too much too fast. So that's where you start to see the shoulder taps. But I think in terms of the movements in dollar yen over the longer term, the pension fund rebalancing, the insurance companies, all these institutions that are really running low unhedged levels in dollar yen, these are the ones that will start to repatriate that capital. Yes, you need some movements coming from the Fed and from the U.S. curve. But essentially at the same time, you also, if you have BOJ tightening policy a little bit more aggressively than what markets are pricing, we will see the repatriating of those flows over time. Which is our expectations. But that's not going to be the short-term trade. That is a process of how they look at an investment, which those rebalancings usually come quarterly or even annually.
If you are just joining us, big moves overnight in the FX market. Allow me to run through them for you. We broke through 160 late last night on dollar yen. This market's just been bullying the Japanese yen, pushing it ever higher over the last month or so. Some big numbers taken out, numbers we haven't seen since the early 1990s. That range this morning, 160.17 at the high, then the low 154.54. Japanese yen kicking in some strength big time in the last few hours or so, and a lot of suspicion that the Ministry of Finance has intervened in this market. The official comment from them so far is no comment. This from Dow Jones, that financial authorities have intervened in the FX market. Mark, I want to wrap things up more broadly in foreign exchange. This came from Eric Robertson of Stand Chart. He said this: for EM, the combination of weaker currencies and stronger commodity prices, you alluded to that, is creating a major dilemma that could put rate cuts on hold indefinitely. Mark, how do you think this story at the moment, pair what's happening with the US dollar with what's happening with commodities, how does it shape central bank decisions worldwide?
Yeah, it's absolutely critical. It's a very strong point. There's a way to think about it, right? If you have strong growth and strong growth is leading to central bank changes, that has one way of thinking the FX market. If it's strong growth and generally contained disinflation, that is bearish for the dollar. And that's where the commodity story kicks in. You get a turn to trade shock. That's good for EM, especially in the context that they have really high level of interest rates in terms of carry. What we've seen recently, though, this is how it changes the market. These are policy shocks. And the policy shocks driven by inflation is what causes rate differentials to matter a lot. So I think you could see this last week. Bank of Indonesia surprised markets by hiking rates. No one was expecting that. We are now dealing with the policy trade-off for G10 and emerging market central banks, that if the Fed is basically priced to the point where they can cut once or not cut at all, or even depending on who wins the election, whether or not they actually have to hike next year, what we're seeing is these policy shocks are usually risk off, good for the dollar. I think in the context of commodities, there's some cushion for the commodity exporters like Brazil and some of the other countries around the world, but it's very small and it's going to be marginal in terms of the context of whether or not these policy shocks driven by U.S. inflation, which is starting to accelerate relative to other currencies that we track and is more bullish for the dollar, that's going to force central banks that had the ability to cut to change their perspective. And that changing of perspective is what tightens financial conditions. And it's what changes the growth outlook for the next 6 to 12 months, which can be mutually reinforcing and negative for risk and strong for the dollar.
Hey, Mark, this was great. Just fantastic to get your view on events overnight. Mark McCormick there of TD Securities. Rate cuts are luxury that many central banks do not have right now. Equity futures positive by 0.2%. Let's get you up to speed on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China's President Xi will visit the European Union for the first time in 5 years. Next week, Xi is going to visit France, as well as Hungary and non-member Serbia. It'll be a 6-day trip. There are visible tensions right now between Europe and China for things like trade and spying allegations. But perhaps top of those tensions is Beijing's support for Russia's invasion of Ukraine. Beijing is pushing to repair relations with the EU, while leaders there have become more assertive in responding to China's trade policies. Senators are dismissing House Speaker Mike Johnson's call to send the National Guard to college campuses. Johnson visited Columbia University last week. He condemned pro-Palestinian protests and said there that it would be, quote, appropriate for the National Guard if demonstrations were not contained. Both Republican and Democratic senators have dismissed the idea. J.D. Vance of Ohio said maybe just call the police, while Tim Kaine of Virginia called it a very, very bad idea. Apple, yet again, facing antitrust headwinds in Europe. This time, it's the iPad. It's going to be added to a list of products that fall under the EU's Digital Market Act. Now, Apple has 6 months to comply with a whole set of new obligations and prohibitions. It's things like allowing the iPad users to download apps outside of Apple's store. It is a clear loss for Apple, but it also underscores the willingness of EU officials to go after big tech, already having taken aim at Microsoft, Meta, Alphabet, Amazon, and ByteDance. That's your brief, John.
Hey, Danny, thank you. We'll catch up with Danny in about 30 minutes' time. Up next on the program, the Fed's change in tone.
There's both a story here about the economy holding up very well with high interest rates, as well as inflation pressures being persistent. I think the case for Fed easing here is pretty small anytime soon.
The Federal Reserve decision 2 days away. That conversation up next. Equities positive here by 0.2% on the S&P 500. A lift again, adding some weight to the rally from last week. Yields are lower. That's helping things. We're down 4 basis points on a 10-year, 462.18. Under surveillance this morning, the Fed's change in tone.
There's both a story here about the economy holding up very well with high interest rates, as well as inflation pressures being persistent. I think the case for Fed easing here is pretty small anytime soon. We'll see what we are 6 months from now. But certainly the Fed's going to have to change its tune about its view that there's a fair amount of easing that's coming down the road.
It's the latest this morning. Sticky inflation data reinforcing the high for longer narrative as the Fed kicks off a 2-day meeting tomorrow. Jay Bryson of Wells Fargo writing this. Stubborn inflation and resilient economic activity through the first few months of the year have left the FOMC little reason to ease policy in the near term. We currently expect the FOMC to first cut the Fed funds target rate by 25 basis points at its September meeting. Jay Bryson joins us now for more. So, Jay, before we get into the Fed call, I want to talk about the data from last week. For all the talk of US exceptionalism over the rest of the world, how exceptional was the first quarter in US growth?
Well, I mean, the U.S. clearly grew faster than the rest of the world in the first quarter. Now, we grew 1.6% annualized. I would say it was actually stronger than that. A lot of that drag was from inventories and imports. And, imports show that domestic demand is actually pretty strong here. But if you look around, the rest of the world, maybe you're eking out positive growth rates. In the EU, maybe you got to eke out a positive growth rate in the United Kingdom. But, in general, the U.S. is outpacing its major trading partners at this point.
Jay, you kind of alluded to it. Just how compatible was that downside surprise on GDP with the rest of the data we had for the first quarter?
Yeah, so, again, it comes down to inventories. There was a fairly large inventory drag. It's sliced off about a full percentage point. And if you look at net exports, that was also close to a half a percentage point as well. And so if you dig down a little bit further, consumer spending grew 2.5%. That's a solid growth rate. We eked out a positive growth rate in terms of fixed investment spending as well. So if you look at the underlying core of the U.S. economy right now, growth in those main drivers of GDP growth is pretty strong.
Let's dig into your Fed call and the month. The month jumps off the page for me, September. Jay, we've had a lot of characters around this table who have said September's not doable because it's too close to the election. Why are you running with September?
So first of all, John, what I would say is the risk to that view of September are probably skewed to the backside, right? After towards the end of the year, I'd certainly acknowledge that. But between now and then, you will get 3 PCE prints. You'll get 3 more non-farm payroll prints as well. Could they cut rates in September? If things are slowing down enough, then yes. Does the election just freeze September? No. The Fed would prefer not to be moving in September. But if you do see, a significant deceleration in the economy, if you do see the 3-month annualized rate of inflation coming back down to 2.5%, you could potentially see a rate cut in September.
So this is Lori. One question for you on your September call is what really gives you the confidence that the inflation data is going to cooperate by September to give the Fed permission to go ahead and cut? And I would say number 2, when you're thinking about, the potential for the hike conversation to come back in, how bad do you think the inflation data would have to be for that conversation to pick back up in markets again?
Yeah, so Laura, let's take the second question first. I mean, I think what you would need to see for, the rate hikes to come back onto the table, I think you would need to see a continued string of 0.3, 0.4 in terms of the month-on-month change in the core PCE. That would show you that inflation is just not coming back down to, the 2% sort of target that the Fed is looking for. And I think that's what you kind of need to see that. Now, so what are we looking for going forward? So we do think that, and the data would show this, that if you look at housing prices continue to decelerate, at least in terms of, what you're actually seeing out there in the real market in terms of rents. We think that will come down. The labor market is also getting into better balance in terms of supply and demand. The quit rate is back below where it was before the pandemic. The vacancy rate is also coming back down to where it was before the pandemic. And so as the labor market gets into better balance, that should slow the rate of wage growth, and then that brings back down the super core rate of inflation. So that's kind of what we're looking for in terms of, the Fed easing later this year.
Jay, you say that the election doesn't make September unmanageable, but what about November? Could they, 2 days after the election, come out and do something in November?
Yeah, and so that's kind of tricky, right? If they are on pause in September, they're going to get a lot of pushback from one side, and then if they go ahead and 2 days after the election they're cutting rates, they're going to get a lot of pushback for saying, these guys just held rates in September to help one side here. So the election does complicate things for them. But if you go back and you look at in other election years, they have moved before, right on the eve of an election. So it doesn't rule it out. It complicates their messaging. It complicates what they're trying to do, but it doesn't necessarily rule out a rate move in September.
Jay, just on the politics, a report from the Wall Street Journal last week that the former president and the team around him reportedly are considering how to be a little bit more assertive around central bank decisions in the Federal Reserve. I'm being diplomatic here, Jay. Jay, I just wonder what your response to that actually was. Do you know how that would work in practice?
I guess I don't really fully understand the question, John, but I guess what you're alluding to here is I think there will potentially be more political pressure on the Fed if the former president is reelected. He put some political pressure on the Fed before, and you could imagine that going forward as well.
You answered the question in the spirit in which it was intended. Jay, thank you, sir. Jay Bryson of Wells Fargo. Jay, appreciate it, following that Wall Street Journal report just last week. AMH, what did you make of that?
Well, let's go to what Terry Haynes had to say over the weekend. He came out with a note saying, quote, forget about it. Because when it comes to the central bank, the Fed, monetary policy is Congress's job to mandate. And to give that to the central bank to look at their dual mandate has nothing to do with the president. But, of course, when you look at potentially who's going to be around the president, you can have some sort of initiatives that would potentially make it a de-dollarization path forward. Yep. They want a weaker dollar in terms of exports, but nothing, at least to Terry Haynes, says that Congress and other courts are going to be able to do to give that authority to the president.
I'm guessing Jay knew exactly what I meant. Anne-Marie mentioned a little bit earlier in the programme, should the Fed be guided by the economic data or guided by the communication we're getting from corporate America? Laurie, can we finish on this quote from Walmart? At Walmart, we're now seeing prices that are in line with where they were 12 months ago. I haven't been able to say that for a few years now. That's an executive speaking to ABC. We've heard echoes of that coming out of the company. What do you think we are learning from corporate America?
So I do feel like the inflation commentary is a little less hot than what it was in the last reporting season, and that's a good sign, right? We're not even halfway through this thing yet, right? So we've got to see what comes out in the next few weeks. But I do feel like it's just a more mixed, more nuanced conversation. I think companies last quarter seemed to really do a good job of keeping expectations in line and talking things down. I'm not noticing that this time around, and we've actually seen S&P EPS, the bottom-up consensus has moved up $2. So we'll see if that continues, but I feel like they've done a good job the last year or so clamping down expectations, and the setup's actually pretty decent.
Big story later this week on the earnings front. Amazon coming up tomorrow, Apple on Thursday. Laurie, love this. Good to see you.
Thanks for having me.
Thanks for being with us for the hour. Laurie Calvasini there of RBC Capital Markets. Let's set up the second hour of Bloomberg Surveillance. Joining us for the next 60 minutes, we'll catch up with Jay Pawlowski of TPW, Bloomberg's Craig Trudown, the latest with Tesla, Tom Forte of Maxim Group, looking ahead to earnings this week, including Amazon tomorrow, and we'll catch up with the brilliant Chanel Desai of Franklin Templeton on this bond market going into payrolls and the Federal Reserve. Equity futures positive here by 0.2% on the S&P. Bond yields are lower by 4 basis points on a 10-year, 462.26. Live from New York City, this is Bloomberg.
The stocks are starting to get a little flashy. We liked them more a few months ago when they were a bit more humble.
We think that valuations are fair. For the S&P to work as we go through the rest of the year, we need to continue to deliver on earnings growth.
The risk for equities now is less about earnings and more about valuations.
We certainly see more value in being able to find opportunities in the U.S.
There's been a lot of good news priced into a lot of the big tech companies. This is a chance to really kind of show me what does the rest of 2024 look like, and then we can go from there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
2 more trading days left before we kick off May. Where is this year going? April has been absolutely bruising. So we close out last week and the headline runs, biggest weekly gain on the S&P 500 of the year so far. And I remembered the headline from the week before, which was the biggest weekly loss on the S&P 500 of the year so far. We have been absolutely everywhere, and we'll be everywhere this week as well. We've got earnings data and a big Federal Reserve decision. Here's your week ahead. It looks a little something like this. The Amazon story kicks off after the closing bell tomorrow. Wednesday, Federal Reserve rate decision. Apple earnings come in on Thursday. Lots of trouble, down double digits through most of this year. Big problems in China. We'll be talking about them in just a moment. Friday, the payrolls report. The median estimate in our survey so far, 250,000. If you want to kick it off with this market this morning, before we get to all of those events, we need to talk about not the equity market, not the bond market. We need to talk about foreign exchange and this currency pair right here. Dollar yen overnight all over the place. So let me give you the range. Higher the session 160.17, lower the session 154.54. Current price 155. This is the official line from the Ministry of Finance. No comment. That's the official line. This is the story coming from Dow Jones. Japan's financial authorities intervened in the FX market. So we had a public holiday, low liquidity, yen's been bullied all month, and it looks like, based on reports, that the Ministry of Finance stepped in. We'll try and get you some more details on that throughout this morning. If you want to know where the price action is in the equity market, equity futures adding some weight to last week's rally. We're up by 0.2% on the S&P 500, a little bit of a lift there. In the bond market, yields are lower by 4 basis points on a 10-year, 462. On a 2-year, we're down 2 basis points at about 4.98. Outside of the yen, in FX on a euro, we're firmer here, 107.16, euro dollar positive by 0.2%. Coming up this hour, we'll catch up with TPW's Jay Pawlowski on why the dollar could be ripe for a sell-off. Tom Forte of Maxim Group previewing earnings from Amazon and Apple, and Chanel Desai, Franklin Templeton, on why this will be a, quote, short and shallow rate cutting cycle. We begin with our top story, kicking off a week of jam-packed data, a Fed decision, some big tech earnings as well, and a US jobs report to wash it all down. Jay Pawlowski at TPW Advisory writing this: we remain constructive on the fundamentals for the US and global economy. We are developing a line of thinking on the dollar that suggests it could be ripe for a momentum sell-off. Jay's with us for the hour. He joins us around the table. Jay, good morning to you.
Morning, John.
Let's start there. That smells like peak US exceptionalism to me, that call. Is that what this is?
Well, it's kind of like that, John, right? I mean, you read about the wrecking ball of the dollar, and you read about how strong the dollar has been, and yet the reality is that over the last 6 months, the dollar is actually down 1%, DXY. You look over the last year, the dollar's up less than 4%. So the dollar yen is a one-off situation, right? It's the extreme because it's the most extreme interest rate differential, right? Rates in Japan virtually zero, rates in the US 5%. Obviously, that's where people are going to play the game. And so the rest of the world, it's nowhere near as extreme as that. And our view is that the rest of the world is starting to recover. The U.S. has already had its peak exceptionalism, right? It was last year. This year, going forward, the rest of the world recovers. China's growing at 5%. Europe is actually escaping recession. Japan is doing well. And therefore, we think, like big tech, right? There was that momentum run. They all ran the Magnificent Seven. Then they rolled over very hard and very fast. NVIDIA down 20% in less than a month, okay, the poster child for AI. So for us, the dollar is ripe for a sell-off. You have the longest speculative position in 5 years in the dollar. Biggest long position in 5 years. You have the ECB getting ready to cut rates, the Fed not ready to cut rates, and what we're looking for is kind of like the catalyst, right? What's going to be the tell? What's going to be the signal? We're setting the story up with that comment we wrote on Friday. The tell could be ECB cuts, and instead of the euro falling,
it rallies.
It rallies, and that suggests growth. And therefore, and we think then the dollar could roll over quite hard and hit a couple technical levels. And instead of talking about 106 to the dollar in DXY, it could break 1 and therefore break 100. And therefore that could be significant for us because we're long emerging markets, we're long commodities, and a weak dollar is very supportive of both of those assets.
Lots to unpack there. Let's start with Europe. I'm seeing echoes of that in the Southside research this morning, particularly from JP Morgan and Mislav Matejka. I'll share this quote with you, Jay. We continue to see an improved relative risk-reward for Eurozone equities versus the US, even in the event of further market weakness, and would look to have as the next step an upgrade of Eurozone versus the US to an outright overweight. So people are starting to pay attention to this theme. What was it that we learned from the downdraft in the last month about what was happening elsewhere and just how well priced the negativity already is?
Well, certainly when we think about that, we look to China, right? And China has been the epicenter of negativity, right? Uninvestable. We've talked about it on this show before, right? With a pro tip, when you hear uninvestable, you go long. And so China to us is the real opportunity, and we've talked about that through things like KWeb and elsewhere. But when you think about Europe, what's interesting to us is that people always make this mistake. They focus on GDP and not earnings. Stocks move off of earnings, not GDP. If they moved off GDP, China would be the best performing market in the world because it's been the fastest growing economy. And that's absolutely not been the case. So in Europe, you know, companies are doing well. A big part of Europe's equity market actually generates its revenue and profits from outside of Europe. And so to us, the opportunity is in Europe. We're long there. The European banks, John, you and I have gone back for years. They've been massive, but they've been massive outperformers here, massive outperformers. And so you got to recognize that. European banks, Japan, China, emerging markets, you know, to us, there's a lot of opportunity in the world.
Jay, you say go long China, but for how long?
Well, I think China has the best risk reward of any of the markets out there, right? All the negativity is priced in. None of the upside is priced in. KWeb's a perfect example, right? The e-commerce market in China is 2 times the size of the United States. It's growing at 15% per annum. The stocks are trading at a 40% discount to the U.S. equivalents. KWeb could double from 26, now it's 28. When we were on last, it was 25, 28, 250, whatever, and then double again to over 100. The 2021 high for KWeb was $102. It's at 28. It could, as I said, could double and double again. So the upside, I think, is absolutely dramatic.
So US tech firms are having some difficulty at the moment in China. Up until this morning, Tesla was one of those. Apple was another. I want to talk about your original take, I think, on what is happening for Chinese firms in China.
Exactly.
You're basically saying they've got the whole market to dominate themselves.
Yeah.
Is that starting to work?
I love it, John, when you remember it better than I do.
Of course.
It's my story, and you remember it better than me. Thank you very much. I hadn't had a chance to look at my notes. But yes, absolutely right. We call it the 2 tech stack divide, right? Basically, the U.S. and China are walling off their tech stacks from each other. And people have focused on that as a negative for Chinese stocks because they're not going to be able to participate here. They haven't yet cottoned on to the reality that that means China companies will dominate that e-commerce market we just talked about, which is growing. It's twice as big as the United States, growing at 15% per annum. It's going to be only available to Chinese companies. And Apple is the U.S. poster child of what that means for U.S. companies, because Apple is very dependent on China.
So if it's positive for Chinese firms, is it negative for U.S. firms?
Exactly. There you go. Yes. China is the biggest growth story in the world. in the biggest, fastest growing region of the world, which is Southeast Asia, which China is increasingly moving to kind of dominate economically, U.S. companies are going to have much less of an area of opportunity there.
Mining and commodities, we need to talk about that as well, and copper specifically. So BHP wants a piece of Anglo. We know why, and it's not the diamonds. And we said on the programme last week, the new diamonds, it's copper. What does that tell you about the future here in this trade and the amount of copper that we need and how you want to get exposure to this? Through 10K last week on the LME.
Yeah, we've been long copper, very bullish. We've been very bullish commodities. We have a double overweight commodities in our global multi-asset flagship model portfolio. And we play it through COPX, which is the copper ETF. And it's been a monster, and it's breaking out, and I think it will continue to do very well because, look, another theme that we're starting to develop, there's just so much going on, so it's so rich in opportunity to talk about things, is an investment age, right? And one of the ages is AI, right? You look at the spending, Alphabet and Microsoft last week, right? $45 billion each on AI. The other is on the whole infrastructure in clean energy and renewable and electric vehicles. And that is copper, and that is commodities. And so to us, that investment age that we see rolling out really supports our kind of multi-year positive view, right? We have a view that 2023 to 2027 is going to be a blue sky global macro period. And this investment build out that we're hearing from companies is really going to underpin that and supports that. So that makes us more bullish, and it makes us want to be long the pick and shovel of AI, which we've talked about, semis, right? And long commodities, physical commodities for the build out. And so it's really semis and copper.
I want to talk about the actual physical picks and shovels. You touched on it just then. And I want to talk about the last 15 years in metals and mining, which you know well, but it's worth going over again. So we come out of GFC, China's booming, so everyone digs a hole. And they keep digging holes. And you give $1 to a miner, it digs the hole deeper. We see that repeatedly. Then comes the bust. We've had some big deals. I was thinking back to Xstrata and Glencore. Monster deals. Everything starts to move south. And they become really, really reluctant to invest.
Yes, exactly.
And I remember Jean-Sébastien Jacques over at Rio. Used to catch up with him often. He's the former CEO. He'd come on the program and he would say, look, now is the time for value over volume. So these guys haven't been building the mines. They've been reluctant to for a long, long time. Are we going to move back into that stage where you give a miner $1, they dig a hole? Or are they actually going to be really reluctant to do so from here?
Well, I think there's going to be some of that, and you're seeing the consolidation first, and then those winners are going to make the decisions on where to build the hole or dig the hole. But, I mean, to us, it's a supply and demand, right? You're touching on the supply side, right? The supply side is constrained because there hasn't been investment in mining for a decade. And these are not projects that you turn on, as you know very well, right? You don't turn them on in a week. Years. Takes years from planning to implementation to then providing supply. So that's the supply side. And then you have the demand side, where copper demand and demand for other metals and minerals is growing dramatically, in part because we're reshaping the entire energy system of the globe. And so these two things together, we think are massive. And, you know, you've had interesting shakeouts. So you talk about the shakeout in the mining, right?
Yeah.
The other side, we're having the shakeout on the clean energy side and the renewable side, right? With the EVs, you touched on Tesla.
It's been ugly.
You know, oh my God, the solar companies, the wind companies, we're in that space because our other model is a thematic model, right? Our TPW20 is thematic. So future tech and climate are the two big drivers there. And that climate segment has been really, really tough the last couple of years, in part because of the interest rate structure, et cetera. So that also could start to pick up pretty significantly at a time when supply is constrained. And we know what happens, right? What brings the two together? Price. And so for us, we think that, you know, 10,000 on copper is not the end of this story.
10K this morning on the LME, up another 0.75%. Jay's going to be sticking with us through the next hour or so. Let's give an update on stories elsewhere. We can do that with your Bloomberg Brief. Let's get to Danny Berger for more. Hey, Danny.
Hey, John. U.S. Secretary of State Anthony Blinken arrived in Saudi Arabia this morning. It's his first stop on another round of visits in the Middle East. In it, the U.S. is expected to push for a truce in Gaza in exchange for the release of hostages. An Israeli official says that if a deal is reached, the country will hold off an invasion of Rafah. Blinken is expected to meet with representatives of Qatar, Egypt, the UAE, and Jordan while in Riyadh, and then he heads to Israel and Jordan. Apple facing more antitrust headwinds in Europe. Now the iPad has been added to a list of products that fall under the EU's Digital Market Act. It means that Apple has 6 months to comply with a whole set of new obligations and prohibitions, things like allowing iPad users to download apps outside of Apple Store. It is a clear loss for Apple, but it also underscores the willingness of EU officials to go after big tech. Saxo told me earlier this morning it's not clear that the sector can outperform now with the growing scrutiny. It's been a tough go for McKinsey employees after the firm cut hundreds of jobs and warned thousands more that the performance needs improvement. But at an event with fellow partners in mid-April, global managing partner Bob Sternfeld said now is a, quote, turn-the-page moment. According to sources, the event was held in Copenhagen and it was dotted with upbeat declarations. The best part was probably the musical soundtrack. It included songs by Eminem and Bob Marley and Tub Thumping by Chumbawamba. I'm not sure what's more motivational than that. John.
Danny, appreciate it. Then we all needed that. Up next on the program, a potential game changer for Tesla. That conversation just around the corner. That stock is higher by almost 10% in the pre-market. From New York this morning. Good morning.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
This is what it's all about. A week full of event risk. Bramo back with us tomorrow morning. Hopefully AMH's voice joins us in the next couple of days. Equity futures positive by 0.1% on the S&P 500. You like that? You can't say you didn't. You can't speak. We're down 4 basis points on a 10-year. 462.39. Under surveillance this morning, a potential game changer for Tesla.
I think long term, China, there's definitely a push inside China to pursue national brands. Apple is feeling that, Adidas, Nike is feeling that, and Tesla ultimately will feel that as well. I don't think Tesla will be a top 3 or potentially even a top 4 brand in the future in China. So, but for now, Musk is playing this game in the short run, and let's see how things develop from here.
Here's the latest this morning. Shares of Tesla driving higher as Elon Musk's surprise visit to China appears to pay off. Bloomberg reporting Tesla will partner with Chinese tech giant Baidu for mapping and navigation functions to support its full self-driving. Tesla also passing a key data security and privacy requirement, which could help the company take the software to its cars in the Chinese market. Dan Ives of Wedbush joined us now for more. Dan, appreciate you jumping on in front of the camera for us to break this down. How big a deal do you think this could be?
It's a watershed moment. I mean, this is 3 years in the making that Tesla has been trying to get into China from an FSD perspective. And this unlocks a golden opportunity, not just for Tesla in China, but I think globally, it's a game changer, in my opinion.
That's what I wanted your view on. Okay, Dan, so China's one thing. What does it mean for the United States and the same thing?
Look, it's important because it's also a shot across the bow, shows what's happening in China, and from a miles run perspective, so from a data perspective, China, that's the golden goose. So this is going to seriously advance Tesla from an FSD perspective, and Musk knew that. That's why he did this trip. It was obviously a surprise one, and I think it's going to come as a surprise in a good way to investors. Long time in the making. It's a trophy case moment for Musk getting back on that plane, come back from Beijing.
Hey, Dan, Jay Pawlowski here. Really enjoy your work. When you say game changer and a global game changer, what exactly do you mean? Does this mean the robo-taxi is coming sooner? Does it accelerate that process? I mean, what's really the game-changing nature of this particular move?
Yeah, it's a great question. Autonomous FSD, when you talk about the golden vision, it can't happen without China. So this was a missing piece in the puzzle. The fact that they got this clearance from Beijing, it unlocks really now the whole vision. And I think that's why it's important in terms of the longer term, what Tesla could achieve, not just in China, but globally when it comes to FSD. And I think this is just the start. It's obviously a win for Baidu as well, but it really shows that now finally it's not just talk, it's walking the walk. I think it's a historical moment for Tesla in its FSD efforts.
And Dan, if I could just follow up a little bit on that. We have a thesis at TPW Advisory that it's kind of, we call it a two tech stack world where China and the US are kind of isolating their tech stacks. And that really creates a lot of opportunity within China tech. And I'm wondering how you think about that. And you said this obviously benefits Baidu as well. What about China tech versus US tech?
Look, I think right now U.S. tech's ahead of China. When we talk about AI, I think with Tesla, they're trying to thread the needle here. They're trying to take that technology, even though Baidu, it's stored in Shanghai, to actually be able to use that globally. And I think it just comes down to there's only two companies that have been able to thread the needle in terms of China-U.S. It's Cook and Cupertino, and it's Musk and Tesla. And that's why this is a huge win for Musk, even domestically, for him just to come in there during the auto show, come out, get FSD approval.
So, Dan, let's stress test that a little bit more. Apple, China right now, not even a top 2 smartphone player. Dan, can we get into that a little bit more? What Jay is making, the point that he's making, is that ultimately the Chinese market will be dominated by Chinese brands, potentially in EVs and likewise in smartphones. Why is he wrong?
Because you make the best products in the world, consumers are going to buy them. And that's why at the top of that mountain, the Mount Rushmore, it's Cook and Cupertino. Now, they're clearly going through growth headwinds now, but I believe 6 to 12 months from now, they're not. I think we'll start to see that Thursday when they report. Look, I think this starts betting against Apple in China has been the wrong move. And in our opinion, it's 220 million iPhones there. 130 million have not upgraded in 4+ years. That growth opportunity will be on the horizon.
You say it's the wrong move, but that short's been paid this year. I've said that to you before. We're down 12% year to date, and China's been a big feature of that. You're not alone this morning, Dan, by the way. I'll throw this out there. This came from Bernstein this morning. They say, buy the fear. They say Apple has derated significantly amid a weak iPhone 15 cycle, fears that Apple's China business is structurally impaired. They're taking the other side of it. You mentioned the numbers on Thursday. What are you looking for, Dan?
Look, in near term, John, that's been the right move, right, in terms of the shorts. But it's like betting against Brunson in one game. That's going to be might be a good move for one game. For the long term, it's not. And I think Thursday, it's really about Apple showing that growth as you go into the June quarter, September, what we're seeing in China, that turnaround's there. And this all sets up for AI coming to Cupertino. And that's what I believe is going to really be the massive drum roll over the coming months.
Hey, Dan, it's Jay again. What about the case for AI opportunity in China? Do you look at any of the Chinese companies as you want to pair, like almost like a global pair trade? You have Apple, you have Tesla. Okay, those are the two U.S. companies that are going to have opportunity in China. What about on the Chinese side?
Yeah, I think Alibaba. In my opinion, that's the play in China from a cloud perspective. Everything they're doing, and I think similar to almost like a Microsoft, Google, Amazon, what they're doing on the cloud, I think that's, in our opinion, probably the best China cloud play when we look at Beijing.
Dan, love it. It's great to catch up, sir. No doubt we'll catch up later this week, going into that big earnings report on Thursday. Dan Ives there of Wedbush. So here's the argument that you're making. Chinese market dominated by Chinese firm. Argument that Dan Ives is making is that US firms make the best technology, consumers are going to buy it.
Yep. Why
is he wrong?
Well, I think China's trying to catch up. He's not wrong today, right? Obviously, that's the case. I think the issue is, we're priced for that is one, right? He talked about Alibaba. Alibaba trades at 8 times earnings. 8, okay? Apple, even after the derating, doesn't trade anywhere close to 8 times earnings. So for one, you buy the cheaper version that's going to go up that curve because there's a national policy for Chinese companies to be dominant players in this space. And he has been right about Apple being able to thread the needle in China. I think that area, that opportunity is getting narrower and narrower. And when China feels like it doesn't need Apple to thread that needle, Apple's not going to be able to thread that needle. And so for now, I'm buying the cheap Alibaba play where it has dramatic upside. and thinking that over time it's going to dominate more and more of that Chinese market.
Jay Pawlowski of TPW sticking with us. Coming up on the program, big tech earnings continue this week for two companies with very different fortunes so far this year. Tom Forte of Maxim Group joins us next to preview Apple and Amazon. Equity futures right now on the S&P just about positive by 0.2%. In the bond market, your 10-year yield at 462. And for those of you on dollar yen watch, through 160 and back down again, 155.89. Two days left in the month of April. Equities so far this morning up 0.25% on the S&P 500. On the Nasdaq up by 1/3% for the month of April. We're heading for the worst month for the S&P 500 since September. It's been a really choppy month, but it's been a very aggressive rally since the end of October. We're down this month by something like 3%. And last week's big week of gains, the biggest week of gains of the year so far, happened just chip away, take a bite out of those losses for April. Let's see if we can do some more work for the next couple of days. Let's do some work in the bond market on a 2-year, 10-year. 2-year still around 5% at 497.47, down 2 basis points this morning. A 10-year around 460 after breaking through 470 just last week. 461.97, down by 4 basis points. We've added a lot of weight to that yield over the last few weeks. In April so far, still up by more than 40 basis points on a 10-year and up by something like 30-odd on a 2-year, something like 35 basis points through the month so far. What that's meant is a really strong, resilient US dollar through the year so far. What that's done to the Japanese yen is absolutely crush it. Dollar yen through 160 earlier, 155.91 on that currency pair right now, down by 1.5%. And a report from Dow Jones that there was some intervention. We'll talk about that in just a moment. Under surveillance this morning, a key week ahead for the US economy. The Fed set to keep rates on hold on Wednesday, with all eyes on Fed Chair Jay Powell's news conference for clues on when and if the Fed might cut rates this year. On Friday, it's the jobs report. Your estimate, 250K. Jay, 30 minutes, we haven't talked about the Fed. How good does that feel? You had a second guess this morning. Honestly, we've worked through so many issues and have not talked about the Federal Reserve. What does that tell you?
It tells me that, it's not really that important, right? The Fed is in the rearview mirror. We're focused on other things, whether they cut in September or November or December is not important. We are willing to trade rate cuts for earnings growth. And that's the trade that we're making. And earnings growth is accelerating, and stocks are going to be perfectly fine as long as that continues.
Was last week evidence of that?
Yes, indeed. It was exactly that. And your point is evidence, right? We've raised rates are at 6-month highs, and stocks have powered ahead. And yes, we've had a little pullback in April, but that's perfectly natural and healthy. It's a feature, not a bug, to have a pullback every once in a while.
Laurie Calvert-Syner of RBC joined us on the program a little bit earlier. Has a focus at times on small caps, and she said this reminds her of the price action in small caps, the moves on mega cap stocks in America. And Peter Cheer of Academy Securities basically asking a simple question: is 10% the new 1% for mega cap tech? These swings, let's go through them, Jay. I did this earlier, it's worth doing again. So this started with Nvidia 2 Fridays ago on nothing, 10% move lower. Then we start last week, we get Tesla. Numbers come out, we pop 10%, $500 billion name. And then we get numbers from Meta. We drop 10% on a $1 trillion name, $2 trillion name, Google, 10% move on Friday. What's that about?
I think it's people all have the same kind of technical levels that they're watching, and market is really increasingly controlled by algorithmic trading, and so they hit levels, and it's just an air pocket. There's no other side anymore, right? Everybody hits things at the same time, and that's why you have this momentum trade, and people are still confused about really where are we going, with the economy, with the Fed, etc. So it's very much a trend following market, a momentum market, and when that momentum ends, then everybody is like, boom, we're out of here. And so to us, that's great, that's healthy. We don't want things to go to the sky because they never go to the sky. We like pullbacks, and to us as long-term investors, we really think the opportunity is in things like some of these tech names, particularly the semis, right? Our view is the AI age is real.
Yep.
It's creating an investment age. I mean, the things that I took away from last week was that Google and Microsoft both said they were going to spend $45 billion or more on AI. Okay? That's two companies. That's $90 billion. So to us, the semis are a no-brainer for just buy and hold and ride through these little mini blips. It's not a problem.
They're the picks and shovels.
Picks and shovels, absolutely.
Okay. You mentioned that a little bit earlier. Let's talk about air pockets and foreign exchange. This one right here. We're talking about levels in FX we haven't seen since the early 1990s. The yen weakening past 160 against the US dollar overnight, then rebounding really strongly. Question, what happened? Dow Jones reporting that financial authorities intervened to support Japan's currency. The country's top currency official saying he had, quote, no comment. Jay Pawlowski, please comment. What's the signal you take from this move?
It's not important, John. It really isn't. Well, look, I mean, the real story is that, here's a question. I'll toss it back to you.
Please do.
What do you think fair value is on the yen, dollar
Absolutely
yen?
no idea.
Yeah, under 100.
That's what you think fair value is?
Not me. That's what foreign exchange strategists, when you ask them what is the fair value, what is the real effective exchange rate, what should it be, they say under 100. So the dollar yen is at an extreme position. It represents the widest spread in the interest rate world, right? Where Japanese rates are close to zero, U.S. rates are at 5%. So this extreme, in my view, should not be taken as a signal as to where the dollar is or is going. It's a false signal because it reflects the unique characteristics of the Japanese-U.S. relationship on the rate side. It does not translate into the rest of the world. And I think this is setting up something that we're starting to pay attention to, and we talked about it at the Open, the potential for the dollar to roll over and have almost a momentum effect, just like we're talking about with tech stocks.
Let's get into that because you mentioned the euro, the single currency earlier. Why is the euro against the US dollar maybe going to be a better example of that in weeks and months to come?
Well, in part, it's going to be interesting, right? Because the euro, people talk about it should be at parity, should be at parity, should be at parity. And yet it's not at parity. And this is after you've had Germany, the supposed economic engine of Europe, really struggling, right? Europe's very interesting because the growth is in the periphery, not in the core.
That's new.
The growth, exactly. The growth is in Spain, it's in Portugal, it's in Greece, it's in Italy. And so it used to be you'd be really concerned about the rate spread between the Italian bonds and the German bonds. Nobody talks about that anymore because Italy's doing fine. Germany is the sick engine. And yet the euro doesn't want to go to parity. Okay? The euro is fine at 106, 107, 105, fine. And to us, that really suggests that in Europe, the bad news is already in the past. We're moving out of the recession. Germany is actually picking up. And as China continues to improve, the rest of the world improves, Europe will improve as well on the trade side. And they also, like the United States, have full employment. And so full employment means consumption. Consumption means the economy is, not going to go into a big decline. So the euro is likely not going into a big decline. And here's the setup. The setup is that the ECB is going to cut rates in June. And most people would say, oh, that should be euro negative, right? Because it's going to widen that rate differential. Our view is it could be euro positive because it suggests that the central bank is now underwriting the growth recovery. And if that's the case, we would look for the dollar to really take a little bit of a tumble, maybe more than a little bit of a tumble, if that ends up being the case. And so that's what we're watching right now.
107.18 on the euro. That currency pair positive by 0.2%. If you want more data out of Europe, in about 23 minutes' time, we'll get CPI out of Germany. Let's talk about some tech numbers. Earnings continue this week from big tech. Amazon due tomorrow, Apple to follow on Thursday. Amazon stock up this year on the back of strong growth for its web services and demand for its Prime membership. Tom Forey of Maxim Group has a buy rating on the stock, a 218 price target. Joined us now. Tom, let's talk about the numbers from last week and how it informs your view on what we might get from Amazon tomorrow. So we know that cloud spend's pretty solid. Ad spend in places like Meta, regardless of what happened with the stock, pretty decent. Likewise at Google. Tom, does that set the bar a little bit higher for Amazon tomorrow?
It certainly does. So the strength in the cloud computing results from Microsoft, from Google, has me more optimistic on AWS. The challenge for AWS has been you're seeing a lot of enterprise interest in artificial intelligence. This has been the positive. Global macroeconomic weakness has been the negative. So you saw late last year some of the slowest growth you've ever seen from AWS. But yes, Google's comments, Microsoft's comments on their cloud computing revenue have me more optimistic than I was last week heading into those earnings.
Tom, what tells you that they weren't just getting a bigger slice of the pie and taking it from Amazon, that actually overall the pie was getting bigger?
For Microsoft, I do think they are taking share from Amazon. So I do think that partly what you're seeing is that enterprise interest in artificial intelligence is starting to have a positive impact on cloud computing revenue. But I do think that Microsoft is taking share from Amazon, which is a big challenge for Amazon.
Tom, can we talk about another challenge for Amazon? It's e-commerce. What is going on with things like Prime? Typically, for many people, they sign up to Prime and they just hope they can forget about it for the rest of the year if they pay annually. And ultimately, all I'm seeing now every single week is a new charge for an extra something that I used to get for free before. Tom, what is happening with Amazon?
So, all right, so I'm going to spin that very positively. When Andy Jassy took over from Jeff Bezos in July 21, he started implementing his vision for Amazon. His vision for Amazon, as essentially the creator of AWS, is Amazon the services company. So I think what you're seeing here is Amazon's much more interested in selling services to enterprises via cloud, via AWS, to businesses via fulfillment by Amazon, things of that nature. Well, that's higher margin revenue, which could have a positive impact on the multiple and the stock. But unfortunately, as Prime members, I've been a Prime member since the late 90s, you are seeing incremental cost, and it is more expensive to be a Prime member, such as they rolled out advertising now, and if you don't want to see the ads, you have to pay an incremental $2.99 a month. But it's all part of Andy's vision of Amazon as a higher margin services company, which should be good for the stock, but may not be great for Prime members.
Tom, with that in mind, the vision going forward, are we going to have another conversation about maybe spinning it off?
Only if they have to. So when you compare and contrast the antitrust lawsuits for big tech, the good news for Amazon investors is we believe that the sum of parts for Amazon, in the event that they were forced to divest AWS, is greater than the whole where the stock's trading. So I don't think they would do it unless they had to. But the good news is if they had to, it could be accretive for investors.
Tom, can we finish on ad spend? I want to just reflect on last week briefly. Overwhelmingly obsessed with the direction of Meta on any single day, especially with big moves like that off the back of the spend. And everyone will be talking about what's happening with the metaverse, et cetera, et cetera. Underlying numbers were really decent. Ad spend is really solid. You saw that at Google, YouTube, et cetera. Tom, what's happening there? What's supporting those trends? And do you think it's durable through the year ahead?
So the good news for advertisers in general is that it's an election year, so you should have an increase in ad spend because it's a presidential election year. The other good news is you're starting to see the signs in the digital advertising improving, suggesting that the economy is holding up maybe better than expected. So that's good news for digital advertising companies.
Tom, appreciate the update, sir. Thank you. Looking forward to the numbers tomorrow. Tom Forder there of Maxim Group. Looking ahead to Amazon tomorrow, Apple on Thursday. Let's get you some news elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A Paramount takeover deal is hanging in the balance. Sources have told Bloomberg that the Redstone family, which controls a majority of shares, and the independent film producer David Ellison of Skydance are both making concessions and appeals to the company's other investors. Ellison, for his part, is offering to buy a block of Paramount shares at a premium. His bid described as the, quote, best and final offer, as the board remains undecided about a Skydance takeover. CEO Bob Bakish could be ousted as soon as today by a management committee. And the bidding war continues. Blackstone has made a new offer for Hipgnosis Song Fund, this time for nearly $1.6 billion, now surpassing a rival fund's bid. If successful, it means Blackstone will gain access rights to a catalog of artists, including Blondie, Shakira, and the Red Hot Chili Peppers. The board of Hipgnosis supports the new offer. The company's been trying to turn music into something like a mainstream asset class, but higher rates have been slicing into valuations. Major League Baseball plans to address issues with its uniform after complaints from players and fans about changes they made this spring. ESPN reports that the MLB will return to larger lettering on the back of jerseys, fix mismatched gray tops and bottoms, and address the Nike jersey's propensity to collect sweat. In a memo obtained by ESPN, the Players Association said, quote, Nike was innovating something that didn't need to be innovated, but the players will have to wait until the start of next year's season for the new kits. That's your Bloomberg Brief. John.
Danny, thank you. Player complaints. Nike not in a good spot right now, that's for sure. Up next on the program, a second chance in fixed income.
Only 3 months ago, we were answering questions from investors. Did we miss the fixed income rally? And we kind of had to say, yeah, you probably did miss a lot of it, maybe all of it. And investors now are getting a second chance.
The brilliant Chanel Desire, Franklin Templeton joining us next on the program, counting you down to a Federal Reserve decision on Wednesday and payrolls report this coming Friday. Live from New York, this is Bloomberg. Equities on the S&P 500 higher here, positive by 0.25% through most of this morning. It's a quiet start to a very busy week. Yields are lower by 4 basis points on a 10-year, 462.18. Under surveillance this morning, a second chance in fixed income.
At some point, the market's going to recognize you can't keep rates up here forever. The Fed's going to start to cut, and you're going to have a massive rally. Only 3 months ago, we were answering questions from investors. Did we miss the fixed income rally? And we kind of had to say, yeah, you probably did miss a lot of it, maybe all of it. And investors now are getting a second chance.
Here's the latest this morning. Treasury yields holding steady ahead of Wednesday's Fed decision. Traders pushing back rate cut bets on sticky inflation data and a resilient U.S. economy. Chanel Desire, Franklin Templeton expecting cuts to start in September at the earliest and writing this. I believe this will be a short and shallow rate cutting cycle and expect that 10-year notes will jump around in a 425 to 475 range. After the shallow rate cut cycle is done, we are likely to see long end yields moving higher due to fiscal pressures. So now let's start the journey with Wednesday, if we can. And great to catch up with you as always. What are you looking for from Chairman Powell in that press conference?
So I think it's going to be the usual. I think, unfortunately, Chairman Powell has a very difficult time sticking with a hawkish tone during the Q&A. So I wouldn't be surprised if in the Q&A, he turned a little bit dovish, left open some roads for rate cuts sooner than I think the Fed probably will cut. But, this is a pretty robust economy. We're looking at a strong labor market. We're looking at decent wage growth. We're looking at decent productivity gains. And the underlying GDP data last week was pretty darn strong. And inflation's sticky. There's very little room for the Fed to be particularly dovish or quick in terms of rate cuts.
At the start of the year, Sonal, as you know, they thought they were on a journey directly towards 2%. And maybe cutting interest rates, and the market certainly thought it was going to be set up to cut interest rates maybe as soon as March. And ultimately we started to get these bumps, and they referred to them as bumps in the road. Do you think they are just bumps in the road, or have they changed course?
I'll just say that if there are bumps on the road, it's a pretty bumpy road, and it's a pretty long one. So, I don't think that these are just bumps in the road. I think what you're seeing is genuine stickiness in inflation, and it's coming from a lot of misreading, I think, of what went on in the post-COVID period, where everyone assumed that, the economy had fallen over and gone to sleep for an extended period, and it hadn't. And there was so much of fiscal expansion during that period, and we continue to see the impact even today. I think it's going to be a long time before we start seeing inflation going all the way back to 2, certainly not this year.
Sonia, Jay Pawlowski here. We were talking earlier before we went live about why one should own bonds or buy bonds, and we're very underweight treasuries here at TPW Advisory. You talked about strong growth. That's the reason why we're very underweight. Strong growth is not really constructive for treasuries. So I'm curious, what would be the case, if you could make the case for buying bonds here at these levels, or what level would you suggest people should get long bonds?
But I think it's very fair. What you're saying is definitely a fair point. On the other hand, I would say that most institutional investors, retail investors are massively underweight bonds. I'm not suggesting going massively long here. We were short and we did go neutral over the last several months, and we're slightly long right now. But I would say that that range that I'm talking about, in anticipation of a rate cutting cycle, albeit shallow, and I don't anticipate that this is going to be the rally to end all rallies, I see some point in actually diversifying. Fixed income ideally plays a diversification role in portfolios, and I think that's really the case to be made to hold treasuries. When I talk about it being shallow, the reason is I think over the longer term, it is inevitable almost that we see treasuries moving systematically higher for a while. So we might see them come down, and I don't expect them to rally all the way down to 2%. I don't expect the Fed cuts to take us to 2%, and certainly treasuries aren't going to rally anywhere close to what we've seen in the last 15 years. But then we will start seeing the sell-off, which comes from the fiscal pressures, which is going to go on for several years, I would anticipate. So it's a period. It's a short cutting cycle. I think that's really important to think about.
Yeah, and I would agree with that completely, Sonia. What about credit versus treasuries? And then could you just touch on that fiscal pressure? Because you're absolutely correct. People have very much underestimated the power of the fiscal side of things because we've been so used to monetary policy driving everything since the great financial crisis. So help me understand the view between credit in the U.S. or globally versus treasuries, and then this idea of fiscal. How much of a window do we have between a rally in bonds before that fiscal pressure really manifests?
So I'd say that the first bit on credit, the reality is all-in credit yields will still give you, if you're talking about high yield, 7.5%. And so you can find pockets of value there. The all-in yield is somewhat attractive, and I can see that. In spread terms, we're looking at pretty tight spreads. Again, the case can be made reasonably, and I'm sure you would make this one, that we're looking at corporates which are in better financial health than they have been historically. So I accept all that. And I think that credit definitely has a space in portfolios. Despite how tight it is from an all-in perspective, there is room for some credit in portfolios, I'd say. The second point that you were making, which is when does the fiscal axe fall? We have begun to see it, and we periodically see it, when the market focuses on the fact that we're looking at 6% plus 6% of GDP plus deficits in a forward-looking way, and this is probably conservative in the event that we have a split Congress at the end of the next set of elections, in the sense that it doesn't matter who wins, right? As long as you have a split Congress, you're unlikely to see much fiscal consolidation. That, I think, is an important factor. I don't think it happens certainly not this year. You know, we're going to see a lot of fiscal spending. That's a given this year. But I think you would continue to see that. When does that really drop, that axe? I think we're going to need to see more of a buyer's strike. And as we see long end yields move higher and higher, I think the US will be forced to do a certain amount of fiscal consolidation. But until we see that, I don't see that consolidation happening, and Treasury yields absolutely can go higher than 5% in that scenario.
Do you think that's a challenge to Treasuries as a diversifier, Sonal? If you think about where the deficit is now, that's going to gap out if we go into an economic downturn, and typically that's when you would buy Treasuries. Is that going to be a challenge to that?
I think there is a challenge to that. I think right now, the growth of the economy is something that we all have to be really grateful for, because right now there aren't that many silver bullets, certainly not on fiscal, and very few on the monetary side. So it's the fact that the economy continues to grow is the one somewhat saving grace here, though the fact that it continues to grow also indicates very clearly that neither fiscal or monetary policy are particularly tight.
Yeah, Sonal, thank you. Big questions for the news conference for Chairman Powell later this week. Sonal Desai there of Franklin Templeton. What did you make of that point there?
Yeah, very solid. I mean, that was a really well-reasoned argument, I think, about how to think about things, not with, black and white, but nuanced.
The fiscal pressure specifically, though, Jay, is that something that concerns you?
Fiscal's been a real boost to the economy. It's been a real support. It's helped that U.S. exceptionalism that we talked about earlier. Going forward, I think it becomes a little bit of a challenge, particularly on the fixed income side. And therefore, those are some of the things that really strike us, right? I mean, the IMF meetings last week, we touched on them a couple weeks ago, right? 82% of those surveyed expect a stronger dollar, right? What we're talking about here, fiscal pressures, the U.S. buyer's strike, I mean, it could really kind of get going on itself a little bit where the dollar goes the other way. And it's set up to do that based on the fact that speculators have the biggest net long position in the last 5 years. So there's something to that, I think.
A major question then is Treasuries as a diversifier. Can you just walk us through in the next 30 seconds, if you can? What's your diversifier? What works?
Yeah, well, the diversifier right now has been commodities, right? Commodities have had a negative correlation with the S&P. They've sailed through this little mini correction very healthily. Our benchmark is ACWI ag, and Goldman Sachs commodity, 50-40-10. So we have an overweight in equities, we have an overweight in commodities, we have an underweight in treasuries because we are pro-growth. And so being pro-growth, we don't see the case for treasuries. We want to hedge out that risk exposure.
Jay, this was awesome. Let's do it again soon.
Absolutely, John.
Good to see you. Thank you, buddy.
Marie, hopefully you'll be able to speak next time.
The voice returns.
We missed you.
In the next couple of days. Jay Pawlowski at TPW Advisory. Thank you, sir. Coming up next, Sarah Hunt of Alpine Saxon Woods, Mandeep Singh of Bloomberg Intelligence, Stephanie Roth of Wolfe Research, and Bloomberg's Ed Ludlow. Big week ahead from New York. This is Bloomberg.
Inflation is not coming down as fast as we expected.
Inflation just has stopped going down. It's stalled at a level that's uncomfortable for the Fed.
They're going to want to be more patient. Inflation is going to be top of mind.
I think the clear part of the new narrative is high for long on rates. The question is, where does that take us?
You can't keep rates up here forever. The Fed's going to start to cut, and you're going to have a massive rally.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Fantastic start to the week so far. Live from New York City. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. Already this morning, Jay Pawlowski of TPW talking about peak US exceptionalism. We caught up with Lori Calvasina of RBC, who reflected on mega cap tech stocks behaving like small caps. We'll talk more about that through the week, no doubt. We have a monster week ahead for you. And it looks a little something like this. Tomorrow, after the closing bell, numbers from Amazon. On to Wednesday, you'll hear from Chairman Powell in that news conference at 2:30 Eastern Time. The Fed decision, 2 p.m. in the middle of this week. Thursday, numbers from Apple. Very challenged stock so far this year, down by about 12%. Challenge in China. Then on to payrolls Friday. The estimate in our survey, a sneak peek for you, 250K. The bond market going into all of that set up like this. A 2-year, 10-year, 30-year. Looks like the following. Very close to 5% on a 2-year at 497. We're down 2 basis points on the session, up more than 30 on the month so far. On the 10-year, down 5 basis points on the session, up by 40-something in April at the moment. 461.56 on a US 10-year. Coming up this hour to discuss some of the big themes, we'll catch up with Sarah Hunt of Alpine Saxon Woods. Following the best week of gains on the S&P 500 so far this year, we'll speak to Stephanie Roth of Wolfe Research looking ahead to the Fed decision, and Bloomberg's Ed Ludlow previewing Amazon and Apple earnings. We begin with our top story, stocks rallying on earnings optimism ahead of the Fed's 2-day meeting. Sarah Hunt of Alpine Saxon Woods saying this: there are plenty of unknowns in 2024. The market may end up more dependent on earnings than usual. If earnings can live up to or exceed expectations, that may not be a bad thing. Sarah joins us now for more for the hour. Sarah, good morning to you.
Good morning.
Let's get to those earnings. You say earnings season saved by just 2 names last week. Is that it?
Well, it's more the theme, right? So the 2 names really are the ones that most encapsulate the theme of AI. They needed to show that there was big growth there. They needed to show that there was profitability there. And they needed to show that there was a lot more investment there. All of those things happened. You could even add Meta to that, because even though there was some disappointment on some of the CapEx that wasn't AI related, I think the fact that they're talking about spending so much more money there is really important. And I think that had that not occurred, this is sort of what the market was hanging on. And you had a huge rally from September of last year, October of last year into this year, and then a huge rally in the first quarter. And if you didn't see that come through, I think there would have been a lot more vulnerability than we're seeing. I mean, you certainly saw it before earnings started.
We reflected on this last week. We should probably do it again. Meta spends a lot and the stock got punished. Alphabet and Microsoft did something similar and got rewarded. What was the big difference for you?
The big difference is that the question of what Meta is spending on, because the AI spend I don't think was the problem. I think it was going back to those Meta labs and how much money is being spent there, and whether or not the discipline that Meta got when the stock had a real problem a couple of years ago and said, no, we're going to focus our spending in these ways and we're going to stop spending so much on what is more speculative but we think is the future. I think there's creeping back in. So I think that was a little bit, and where the stock was too.
Mike Wilson of Morgan Stanley was with us last week, and he was very keen to point out, of course, the usual, which is the data is one thing. How the stock responds to that data is just as, in fact, it's more important. What did you take away from these big double-digit moves on Uber cap tech names? 10% in either direction. Peter Schiff of Academy, I've said this repeatedly through this morning, is 10% the new 1% for some of these tech firms, and you anticipated more of the same this week?
So I think that there are some one-off reasons why those stocks moved so much. And part of it was that the tech stocks had actually come off the most in April. And the first quarter wasn't as strong as the back half of 2024 for some of those tech stocks. And I think it was a huge relief because the concern was if this doesn't go the way that it is supposed to, these stocks are expensive. And can the earnings grow into their multiples, right? Because there's a lot of conversations about multiples. And why isn't, even though stocks have surprised to the upside, why aren't stocks moving higher? Well, those earnings needed to be there because those multiples had already moved. So I think that that's a lot of where you were. And I think for those two in particular, it was just relief. And it was like, well, this is great because you're seeing big growth, and growth is what's really important for these stocks.
You say earnings season has been saved. What are you expecting now? Are you anticipating Apple and Amazon to continue saving the earnings season?
Well, I think that for Apple, there's more one-off issues, right? You've got the China issue, you've got some current concerns. I don't think longer term there's a problem for Apple, but I think shorter term, there's a reason the stock has not performed as well as the other ones. Amazon is also a little bit, let's see if AWS can grow as much as you did see the cloud grow for Microsoft and for Alphabet. And AMD is this week too. You know, we want to see what the semiconductors have to say. There's still a lot to go, but I think that those two giant bellwethers, if it had gone poorly, it would have been a problem. Now, saved forever, I don't know, but certainly, like, the beginning of April was not pretty, and we certainly saw that reverse a little bit last week.
What's your read so far on the international cyclical story and the challenge from places like China? The challenge particularly for a multinational that's based here in the United States that has to have that stronger dollar translated back in from that foreign currency. What's happening there? How big a challenge is that?
Well, it certainly depends on the company, and it certainly depends on the country. I mean, you've been talking all morning about the Japan versus U.S. currency. There's been a lot of other less severe movements in other currencies, and I think that, you know, we're still trying to grapple with how we came out of this pandemic, right? Like, there's still not the normal playbook of X happens, Y happens, recession happens, this happens. That just hasn't been what's occurred. So we're still trying to figure out exactly what that means and how to work with it.
Can we tease that out a little bit more? Because I think you're onto something really important. When we come out of GFC, we were always looking for the Federal Reserve to hike interest rates. We had a lack of understanding about the current cycle, so just anticipated a return to the previous one. And it was false dawn after false dawn waiting for those rate hikes. They just never came. You had to wait until 2015 for them. And then you had to wait another 12 months to get another one after that. Do you think that's what's going on now? There's just a lack of appreciation for where we are currently. So we sort of gravitate towards what it used to look like pre-2020.
Well, this is the whole question of where interest rates are going to go. Are we renormalizing to pre-financial crisis levels, or are we just normalizing and then we're going to go back to the low interest rates post the financial crisis? If you think that we're normalizing to pre-financial crisis levels, 5% is not insane. And it's also not so high that people can't manage it. It was the speed that people were concerned about, and rightly so. It did catch up some banks, and there's still some questions about commercial real estate. There's plenty of unknowns and plenty of questions and things that you can get really worried about. But the truth of the matter is 5% on the 10-year or 467 is not insane. And if we think about more normalizing, the idea that we're going to cut all the way back to 2 or all the way, you know, to some much lower number, you have to wonder whether or not you cut back to at some point, but not to some level that's more post-financial crisis than pre-financial crisis.
You mentioned we're not out of the pandemic era yet. When do you think we would know when we're out of it?
That's an outstanding question for which I do not have an answer. I think that you start to see things react more like you expected them to pre-finance, like the playbooks start to work again, and the things that are normally correlated correlate again, because we have such odd correlations, and we have so many things. All these things move together when they don't usually, in positive or negative. I think when you start to see some of those historical relationships, if you keep interest rates in what is considered a more historical level, those relationships start to reignite. Then I think you can say, okay, we have finally started looking at that. But I mean, what is that going to look like for commercial real estate, for office? I don't know, because we're working 3 days a week in the office and 2 days at home. I think that there are some things that are going to stay, and that's a longer term prospect to how that sorts itself out.
Just for the record, we're working 5. We're very happy about it. Very happy about it. So let's talk about sectors. We started this month with this big hope about a rotation. Saw a lot of that in the month of March. Then it's faded and faded so rapidly. In fact, hardly any guest even brings that up on this program anymore. Going into small caps, looking elsewhere beyond big cap tech, particularly after last week. Where are we now with that question?
I think that it's bad. You have to have some sort of a balance, right? Because last year it was all about big tech, and that's all that worked. This year there are more things, there are other things that are working as well. But when big tech reasserts itself, people start to go right back to it. It's the huge amount of cash flows. I think balance sheets are going to matter. Sectors matter, but balance sheets are going to matter. Utilities are the new hot sector because of the fact that data centers and AI need so much electricity. So there will be ways that this broadens out. But in terms of a wholesale shift away from technology, it's difficult for me to see why that would be sustainable, just because the cash generation is so insanely huge. And that's really important. And the growth is still there. The growth hasn't gone away from that. So it's about broadening out and adding to as opposed to switching from.
Let's talk about the financials. Banks have had a pretty decent run. If I think about what's performed well relative to how much it's talked about, this is hardly talked about. The fact that we've got JP Morgan up this year by 14%, Goldman up double digits, Citi up 21%, big turnaround story there with Jane Fraser, Bank of America up by double digits, even Deutsche Bank up by 24%. What's supporting some of those banks at the moment?
Well, I think that some of it was a catch-up trade. I mean, these stocks had been absolutely brutalized, even though things were going okay. The idea was if we're going to cut rates, it's going to be better for banks, and that's great. And then that story started to fade, and the banks just started to really not perform enormously well. European banks have been under scrutiny for a long time, so it's a little bit of a bounce back. And hey, if Europe is going to be okay, then the banking sector should be okay. And these stocks are really cheap. In the US, they were also less expensive, but you've also had a consolidation. So the bigger banks are doing better, and the smaller banks, the regional banks, are still struggling. And I think that that's just going to continue. It's sort of like the story of the mega caps, not just in tech, but across the sectors.
Sarah Hunt is going to be sticking with us for the hour. I wanted to bring you this note from Mislav Matejka of JP Morgan on Europe versus the United States. I mentioned this earlier this morning. Interests me. I'm not sure if you're all aware of this. We don't expect Eurozone to directionally decouple from the US, but it's interesting that in the recent bout of market weakness, the S&P was down 5 to 6%, in contrast to the Euro Stoxx 50, which was down only 3%. Here's the quote, the important one. We continue to see an improved relative risk reward for Eurozone equities versus the US, even in the event of further market weakness, and will look to have, as the next step, an upgrade of Eurozone versus the US to an outright overweight. People getting more constructive on the European story relative to what's in the price, relative to what's expected here in the United States. And those comments echoed by Jay Poloski of TPW in the last hour as well. Equities this morning on the S&P positive by 0.25%. Sarah's going to be with us for the hour, I'm pleased to say. Let's give an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. U.S. Secretary of State Anthony Blinken has arrived in Saudi Arabia. It's the first stop in another visit to the Middle East. The U.S. is expected to push for a truce in Gaza in exchange for the release of hostages. An Israeli official says that if a deal is reached, the country has agreed to hold off from an invasion of Rafah. Blinken, on his trip, is expected to meet with representatives of Qatar, Egypt, the UAE, and Jordan, all while in Riyadh. Then he heads to Israel and Jordan. China's President Xi will visit the EU for the first time in 5 years. Next week, Xi will visit France and Hungary, as well as non-member Serbia. There are heightened tensions with the EU at the moment over a number of issues, from trade to spying allegations. EU members have also knocked Beijing for supporting Russia's invasion of Ukraine. China, for its part, is pushing to repair relations with the EU. Leaders there had become more assertive in responding to China's trade policies. And Spotify CEO Daniel Ek is cashing in on big gains from the stock's rebound. He filed to sell about $120 million worth of shares. Spotify is on the back of its biggest gain of almost 2 years. It swung to a profit in the first quarter. It does appear to be the year of taking profits for tech billionaires, thanks to a neat run-up in the sector. Michael Dell, Jeff Bezos, Mark Zuckerberg, all of them have cut stakes in the companies they founded over the past few months. That's your brief, John.
Danny, thank you very much. Appreciate it. More from Danny Berger in about 30 minutes' time. Equities doing okay, up 0.25%. Some big moves in the Japanese yen overnight. We'll update you on those in just a moment. Up next on the programme, regulators taking another bite out of Apple.
It's easier for Europe to do a lot of regulation, where in the US, the technology sector plays a crucial role for economic growth. I'm not so sure, actually, that the technology mega caps will continue to be an outperforming force in the market going forward. I think the tide is turning a little bit here.
Mandeep Singh of Bloomberg Intelligence weighing in on this story and looking ahead to the numbers from Amazon and Apple later this week. That conversation on the other side, live from New York City this morning. Good morning. Equities on the S&P 500 doing okay. Starting there on the S&P at the moment, we're positive by 0.25%, a little bit of a lift following a big week of gains last week, the biggest weekly gain on the S&P 500 of the year so far. You'll hear lots about that, less about the fact that it followed the biggest weekly loss of the year so far on the S&P. And in April, we're still down about 3%, the worst month going all the way back to September. Remember, this rally has been a rip-roaring one since the end of October. Yields are lower by 4 basis points on a 10-year, 461.97. The big story in foreign exchange is this one right here. If you are just tuning in, welcome and looking forward to spending the week with you. This move in the Japanese yen is the one we're all talking about. Through 160 for the first time since the early 1990s. Gapping a lot lower off the back of that, all the way back down to as low as 154.54. At the moment, about 156. Plenty of speculation about so-called yen intervention. You get it? Yeah, okay. So-called intervention from Japanese authorities. They haven't said they have. They haven't denied it either. They're just saying no comment. Dow Jones says they have. Based on their sources, Japan's financial authorities did intervene in the FX market overnight. So that's where we are. That currency pair negative 1.2%, a stronger Japanese yen after a much, much weaker one overnight and through the month so far. Under surveillance this morning, regulators taking another bite out of Apple.
It's easier for Europe to do a lot of regulation, where in the US, the technology sector plays a crucial role for economic growth. It creates a more difficult and less opportunistic environment, but I think US technology companies will still continue to thrive. It's just a different environment going forward. There's just a lot of scrutiny going forward. I'm not so sure actually that the technology mega caps will continue to be an outperforming force in the market going forward. I think the tide is turning a little bit here.
So here's the latest. EU regulators giving Apple 6 months to ensure the iPad's ecosystem complies with the new Digital Markets Act. Despite the crackdown, Bernstein recommending investors, quote, buy the fear, upgrading shares to outperform with China concerns, they say, which are overdone. Their stock is up by 2.5% at the pre-market, ahead of earnings on Thursday. Mandeep Singh of Bloomberg Intelligence joins us around the table. Mandeep, let's start there. What are you looking for from this big giant on Thursday?
Well, I mean, to me, Apple is always about the iPhone shipments and the services revenue more and more, given, that's a high margin revenue stream. But in this case, everyone seems to think Apple China issues are overdone. To me, what really stands out is how well Huawei has done in terms of developing an alternative and how well that phone is doing. So as long as there's no alternative to the phone, we could argue, it's a very sticky product. People have to refresh. There's no choice. But now there is an option in China. And I think that's what stands out.
Can we get into that word overdone? Overdone because it's not as bad as everyone thinks it is in China, or overdone because it's so well priced so far this year?
Well, I think, again, the 20% revenue stream that you have to kind of model how much are they going to lose that share over the next 2 to 3 years. Previously, people were modeling maybe they will lose like 1 percentage point of share. Now we are talking about the revenue even disappearing over the next 5 years. So that's a totally different assumption. And if that plays out, then clearly that's not reflected in the stock.
So when you say disappearing over the next 5 years, are you talking about the market moving so far away from Apple that they're really not selling very much in China at all?
Yeah. That's, and they have to obviously shift their supply chain. So that's the cost side of the equation. But in terms of the revenue hit, now we are talking about tangible competition that can actually take share. Previously, that wasn't the case. And I'm not even bringing in the AI aspect that, it has got more AI features like the Android ecosystem. It's just the fact that they have a domestic phone that's comparable in terms of features. That's a big deal.
Mandeep, how much is this driven by policy coming from Beijing versus actually demand in China?
Well, so again, I think it's hard to separate the two simply because there is an outsized influence in terms of what goes on, with the people's preferences in the region and how the government does have an influence. So clearly, whatever the government did with the, preventing the government employees from accessing the iPhone did have a bearing in terms of that early step. And now we are seeing that trickle down to the consumer. So to my mind, as long as they can provide all the features and that experience on the phone that everyone is looking for, people will migrate because that's coming from the government. In the end, they provide the infrastructure, the towers and everything, and they can make sure the domestic phones function better.
So that could be a bigger problem than I think anyone is really anticipating. I also wonder from the consumer standpoint, if you're going to see that much switching just because of the brand consciousness and whether or not what kind of analysis is going on right now in China about how Huawei is positioned and how people perceive it, because there is a luxury aspect to Apple. So the idea that it would go away completely, I could understand on the functionality if the functionality was somewhat less practical, but it's a little bit a lot to think that that could just go away entirely, again, given the sort of the brand aspect of Apple and what that stands for.
You're right. There is a luxury aspect, and people in China still buy the Louis Vuitton bags there, with all the preferences they have. So there is that aspect. But look, in terms of the phone, it's about the features and the data. The biggest lock-in that Apple had was it was very hard to move the data out of the iOS ecosystem. Now, if people are switching, they're moving to Huawei phones.
Yep.
Guess maybe that problem is solved. And that's where, the stickiness suddenly gets questionable. Okay.
That's what I want to get into. Can you talk to us about how that stickiness has been reduced in China because the way they regulate the ecosystem and what China's allowed to do is so different compared to, say, the US and Europe? Can you go through the differences for us?
Yeah, I mean, what we are seeing with Digital Markets Act is an example of that, where they're saying the gatekeeper companies shouldn't have an undue advantage with the default apps, shouldn't just lock in their customers by virtue of holding all their data and not letting that data move out of the ecosystem.
And that's already the case in China?
That's already the case in China. I mean, that's what they have implemented. They've basically made sure the app stores complies with their set of rules. And in their set of rules, I mean, if you have to operate there, then you have to let all these things happen.
So what argument will Apple have as the EU tries to do the same thing?
I mean, they are complying. It's just Apple's pitch has always been, when you come to the Apple marketplace, you get access to the most consumers. So if you're a company, a new app developer who wants maximum access, then you have to come to the Apple App Store as opposed to going to an alternative app store. Even if it charges less, you're not going to get those, 500 million plus users that you are going to get in the Apple App Store.
Will the data security risks argument work?
I think that's what's going to slow this thing down, that even if you have an alternative app store, the fact that if you download an app, it's going to expose your operating system and your data, why would you do that as a consumer? And so that is a very powerful argument, but the companies that are offering the alternative app stores have to make sure, they really they kind of bring that offering that consumers are convinced. So if it's a like of, let's say, Netflix or an Amazon that is offering their alternative app store, then maybe it's a powerful argument to say this is safe enough for me to download an app and keep using that app store because I can save on that commission.
I think this is going to end up being one of those things where experience is going to teach us what's going to happen, because it sounds like there's a lot of possibilities and there's a lot of reasons why you could say, yes, that works, but it sort of reminds me of economics in general, which is here's a bunch of data sets and we're going to ignore all the other stuff and see how that plays out. But it does sound like there's more threat there than I think the marketplace is appreciating, at least at the moment.
And the payments aspect. So I think the fact that they will have a lot more alternative forms of payments, everybody as a developer would try to save on that 3% payment cost if you can get it lower, because Apple does have to allow alternative payment systems now. So I think that is the easy substitution that developers will look to make.
So Mandeep, 2 more Mag 7 names to come this week. The final Mag 7 name at the end of May, I think on the 22nd, right, for NVIDIA. What's the big takeaway so far? We've heard from the likes of Meta, Alphabet, Microsoft, Tesla. What's the big takeaway for you?
I mean, CapEx is going up, and it will go towards buying NVIDIA's chips. So clearly there is that insatiable demand, and everyone called out the supply constraints. Even Microsoft said they're supply constraints. So if a company with that kind of CapEx budget is saying they're supply constrained, that tells you something.
Do you think the bar for NVIDIA just got a little bit higher then over the last week?
It has, and it's reflected in that run-up in the stock over the last week. So I think, again, as I said previously in your show, the next 2 quarters does look good for NVIDIA in terms of the demand and, them coming out, beating and raising. But it's always about tougher comps. What do you do after you, are past these comps? And I think it's a tougher bar as they continue to go along.
They're just in the business over the last few years of just beat and raise, beat and raise, beat and raise, beat and raise. Mandeep, this was awesome, as always. Mandeep Singh there of Bloomberg Intelligence. You will see plenty more of Mandeep through this week. We'll get numbers from Amazon tomorrow, Apple on Thursday towards the end of May. May kicks off in 2 days. Unreal. Towards the end of May, you will hear from NVIDIA. This just in from Goldman Sachs. Their view for Friday, payrolls 275K. is the estimate. The median's 250. This is really punchy stuff going into Friday. Much more still to come. We'll catch up with Stephanie Roth of Wolfe Research, looking ahead to the Fed on Wednesday and payrolls to round out the week. Live from New York. Good morning. $60 minutes away from the opening bell. Equity futures here positive by 0.2% on the S&P 500. On the Nasdaq 100, doing okay as well, up by 0.4. Small caps been up and down and all around. It's been difficult for small caps since the end of March. The Russell's just about positive by 0.25%. Turn to the bond market. Big moves there this month, that's for sure. Up by more than 30 basis points at the front end of the curve on the month, up by more than 40 through the month of April on a 10-year maturity. We're down by 3 on the session to 462.80 on a 2-year to 497.67. Talked lots about payrolls. We'll do more of that in just a moment. But the median estimate in our survey at the moment, 250,000, which is still pretty punchy stuff considering at the start of the year, everyone was looking for a recession and they were looking for rate cuts to start by March. Yeah, OK, that didn't happen. Turn to this board in foreign exchange. Big moves here too. Coming into the month, we're at about 152. You got 160 overnight on dollar yen, 156.39. Gapping higher, then gapping lower. Big move lower, negative by 1.2% on the session now. So that's a stronger Japanese yen and plenty of speculation, as you might expect, on whether there was or wasn't intervention. Based on the Ministry of Finance, which has control over this situation, I do not put any emphasis on the word control whatsoever. They said no comment. Dow Jones said that there was intervention based on their sources overnight. Is it sustainable? That's your judgment call. At the moment, that currency pair is 156.34. Under surveillance this morning, a Paramount takeover deal hanging in the balance. The CEO, Bob Bakish, could be replaced as soon as today as the Redstone family and independent film producer David Ellison of Skydance appeal to other investors. Ellison is proposing to buy a block of shares at a premium. The Redstones agreeing to let non-voting shareholders approve any possible transaction. Sources telling Bloomberg that Skydance's bid is considered the best and final offer. AMH, talk about a mess. This stock is up at a pre-market by 5%.
Also, we should note that Ellison is not just a producer, but it's Larry Ellison's son, probably why he has the capital to buy some of those shares, that block, for a premium price. And it does look like, given that, potentially this deal could go through. Although the market is interesting that the shares are rising, they're going to get rid of the CEO. And Jonathan, this is what one report has out of Barron's. And, quote, office of the CEO unit. All the divisions head would then start running the company. There's
been a fair bit of investor pushback around this story as well. That stock is high by 5%. Look out for more headlines on that. A little bit later, no doubt Ed Ludlow and Caroline Hyde will pick up that story on Bloomberg Technology later on today as well. We'll catch up with Ed in about 15 minutes' time ahead of their programme. The Tesla CEO, Elon Musk, securing a crucial partnership during a surprise visit to China this weekend. Bloomberg reporting that Tesla will use Chinese tech giant Baidu's mapping and navigation functions to support self-driving. The partnership helping Tesla to clear 2 key hurdles in the world's biggest auto market. Tesla also passing a key data security requirement. Their stock is up now. Look at this, up by more than 12% in the pre-market. Sarah Hunt's been with us for the last 30 minutes. She's with us for the next 30 as well. We were having this conversation this morning with Jay Pawlowski of TPW, and Jay made the point about Chinese brands dominating the market in China and foreign firms struggling. And Tesla is one of those companies we're talking about. It's up this morning. Where do you see the ability of US firms to compete in the Chinese market effectively? How difficult is that going to be?
I think it's quite difficult, especially with what we've just been talking about with Apple and Huawei. But I also think that what this demonstrates is that Elon Musk saw an opportunity to go in there and say, look, I want to do this, because you've seen the clashes that have been going on between the U.S. and China. He's trying to put a foot in both sides and say, look, I've got this technology. And he had the premium brand in China. And then all of a sudden, the EVs in China started to get less expensive and Tesla started to lose share and he had to drop prices. So to me, this is a way to say, I'm going to change up this math for myself. But also, if I can be successful in this, then maybe I get to be the outlier.
Do you think there are some CEOs that are better at this than others? I'm thinking Tim Cook, Elon Musk. Are there certain CEOs of American firms that can play the China story just a little bit more delicately, diplomatically?
Well, you would hope that you could for Apple because they make so much product there, right? But I think that what Musk is doing is quite smart, and he's going in there and saying, look, I can bring you this functionality that you don't have, and I can use Chinese technology to do it. And I think that is one of those, consummate salesman. He's been able to explain to people, I can do this, I can do that. Even with what's going on with the numbers, which weren't that great, I'm going to bring a lower price car. It's going to be fine. And I think a lot of people were short Tesla. I think a lot of people were worried about Tesla. And I think what he's done is he's just thrown a whole bunch of more information at you and said, this is all going to be great. And let's hope that the numbers can prove it out.
If you were short overnight, you're getting squeezed now in the pre-market up by double digits. Elsewhere, investors looking ahead to a busy week. On top of tech earnings, the Fed's two-day policy meeting starts tomorrow. With a rate decision coming Wednesday afternoon, Fed Chair Jay Powell expected to hold rates steady. Bloomberg Economics anticipating more hawkish rhetoric as US data continues to run hot. We'll round out the week with payrolls on Friday. Stephanie Roth of Wolfe Research, looking ahead to those two big events, joins us around the table. Stephanie, good morning to you.
Good morning.
Can we start with payrolls and skip the Fed just for a moment?
Sure.
250, median estimate. Are you looking for a punchy number as well?
We are looking for a punchy number. We're looking for 270, but we're looking for a softer average hourly earnings number, which is arguably more important in this environment.
Supply side story.
Supply side story.
How much immigration are we getting?
We're getting a lot. I mean, if you look at the CBO's numbers versus where they were a year ago, it's about 1.5 to 2 million more people per year than they previously expected. And this is why we're talking about 250 type numbers, and we're not that scared of it.
Which is such an interesting combination with the fact that we're looking for higher inflation in that people are spending money, but our wages going up so much because we've got this influx of people. And I think that that's where it's a tough thing from an economic standpoint, because the wages can't move up as fast if I have plenty of labor supply. So people are getting hired, but are they getting hired at high enough wages to deal with the fact that goods have essentially, and food and things have shifted up in terms of pricing? Those levels aren't come down, even if inflation is slowish.
So, I mean, I think when you look at from the start of the pandemic, you look at prices of most goods, core inflation, they're up kind of in line with where wages are so far. So consumers can generally afford what they're paying. They just don't feel great about it, which is why consumer spending has held up fairly well. If that wasn't the case, then you would have seen a demand destruction type of environment, but that hasn't been the case. We've seen a resilient consumer because they've been frankly able to afford it on average. It's just they don't feel great about it. Now, looking ahead, we should see core inflation, and now we're seeing core inflation running at something like 3%. It's not as if it was anything like what we saw. And the consumer's still in pretty good shape. We saw that on Friday. That was one of the bigger expectations, with the savings rate falling back down to 3.2%.
Well, that was going to be my next question, which is the savings rate has come down and credit card balances are going up. So when people can afford it, but are they putting themselves in a financial position that's more precarious than they were? You had this whole period of time during the pandemic where everybody built up their household balance sheets. Are we going back to a point where it's expensive? I mean, you just think about the rates on credit cards right now. You're carrying a credit card balance, that's all of a sudden you're paying 21% on that.
Yes, when you look at consumer borrowing overall, it actually is kind of steady, similar to where we were from a growth perspective in the last cycle. Credit card balances have risen slightly higher than average, but not that materially. So it's not really being driven by credit. It's a combination of, we still have this excess cash, which there's been a lot of revision to the estimate, but the excess cash is still kind of there. Nominal income growth is really strong because we have strong wage growth, strong employment growth. So the consumer is able to sort of spend because of things that are kind of combination of income growth, some excess cash. So it's been an environment that's not really being driven by leverage.
Last jobs report, though, we saw the percentage of people who had to go out and get a second job or even a third job to support that spending. That was up. Do you expect more people are doing that?
There's probably an element of that, but I think it's more driven by sort of domestic labor force growth from combination of these new people. From an immigration perspective, we've estimated that it adds about 20 basis points to consumer spending over the past 2 years, which is decent, but it's not monumental either.
So take me to Wednesday. Let's take the data and push it through Wednesday. We've been talking about how confident Chairman Powell is for the last 4 months. He needed some more confidence. He's clearly lost some confidence. How much confidence should he take by that story you're telling in the labour market?
I think he believes it deep down, but I don't think he can rely on it at this point. I think after the third, and he was the last one of the big Fed speakers to come out and say, okay, fine, we've kind of lost confidence, and by March we're not feeling great about the data. Our base case is you'll start to see the inflation data start to soften in the next couple of months, and then there might be some restoration of the confidence, but he's not going to be able to communicate that on Wednesday. It's going to be probably a fairly hawkish press conference.
Isn't it at least better for him that there's growth that's coming through this, that he's not in a position where the inflation is high and growth is slowing at the same time so dramatically, that the stagflation story that's been around for a while, that we were going to go back to the 70s, it looks like we've got good growth. And I think people can handle those higher rates if growth is pretty good. And that seems to be what both the stock markets are reflecting and what the economy is reflecting. What are you looking for in the next couple of months on the data points to see which way we're actually going and you think that the Fed is going to end up being most focused on?
Yeah, and I think that's going to be one of the most important questions that might be asked to Powell on Wednesday is, are you now getting concerned about growth being too strong and that putting a wrench in your inflation story? I think he'll say it's okay, we still have the supply side, but we have to keep an eye on it. Our base case is that you'll start to see core inflation run at about 0.2%, and this is core PCE, 0.2% month on month, and that's kind of the bogey that they'll need to be able to cut. But July is probably looking a little bit soon. It's a tough hurdle. But they'll still probably be able to cut this year. But it's going to be you're going to need to get that inflation coming down closer to that 0.2%, which is closer to the Fed's target. Our base case is you have seen a lot of seasonality in the data in the first quarter. So we genuinely agree with the Fed that has been talking about the seasonality problems. We were worried about the seasonality in Q1. It goes the other way in Q2 and then throughout the rest of the year.
Interesting. Sarah, this is the big equity market question, isn't it? Are we putting off rate cuts for the right reasons or the wrong reasons? From an equity investor perspective, still the right reasons?
It still looks like the right reasons, yes. And unless that changes, I think that's another reason that with the earnings coming through, people can look at the market and be comfortable with it. And the question really is, if we start to see the wrong reasons, I think that's going to be a much bigger issue.
The stagflationary feel that some people thought we had in the data last week. What did you make of that? Just walking away from GDP last week and seeing some notes mentioning the S word, stagflation.
Definitely not stagflationary.
Hard no.
Hard no. So when you look at the GDP data, okay, fine, it missed on the headline number. You had a one handle on your print. But when you look at the details, it was driven by trade and inventories, which are incredibly volatile. Imports were up pretty strong. That's not a sign of a stagflationary economy. So if you strip out trade, inventories, and government, your domestic demand was growing 3.1%. That's not a stagflationary type environment.
Stephanie Roth of Wolf Research. Stephanie, love it. It's good to see you. Remind me of that number for Friday?
270.
270.
And 0.18 on wages.
Okay, appreciate it. That latter point's the important point, right?
Sure.
Impressive. Okay, let's get an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Senators are dismissing House Speaker Mike Johnson's call to send the National Guard to college campuses. Johnson visited Columbia University last week. There, he condemned pro-Palestinian protests and said that there would be a, quote, appropriate role for the National Guard if demonstrations were not contained. Both Republican and Democratic senators dismissed the idea. J.D. Vance of Ohio said maybe just call the police, while Tim Kaine of Virginia called it a very, very bad idea. U.S. junk bonds finally eked out gains last week after suffering 3 consecutive weeks of losses. Supply was light and corporate earnings were strong, helping to prop up the market. Yet Mike Scott of Man Group says the market is overlooking unsustainably over-leveraged business models. He spoke with me earlier on Bloomberg Brief.
As rates start to percolate their way through the economy, through the refinancing channel or through cash flows of businesses, this becomes much more of a cyclical issue. Certainly not the case today, but we certainly could very much build a more negative view around the default rate cycle picking up from 2025.
And you can watch The Brief every weekday morning at 5 a.m. German bonds are retaining their bid this morning, despite German inflation accelerating for the first time since December. The euro, for its part, is holding on to gains it had before the data. ECB President Lagarde has already reiterated she won't pre-commit to any rate path beyond the summer, helping to anchor bond yields around current levels. Data for the full Eurozone is due tomorrow. That's your Bloomberg Brief. John.
Danny, thank you. Great work as always. We'll see you tomorrow morning. The ECB, the next meeting, June 6th, I believe, and we're looking for that first interest rate cut. As Danny suggested, after that, kind of no man's land. Up next, Amazon and Apple on deck.
Betting against Apple in China has been the wrong move. And in our opinion, it's 220 million iPhones there. 130 million have not upgraded in 4+ years. That growth opportunity will be on the horizon.
In just a moment, we'll catch up with Bloomberg's Ed Ludlow, live from New York. This is Bloomberg. Monday morning. Good morning to you all. We are about 45 minutes away from the opening bell in New York City. to kick off a brand new trading week with futures positive by 1/3%, around about 1/4% higher on the S&P. Under surveillance this morning, Amazon and Apple on deck.
Betting against Apple in China has been the wrong move. And in our opinion, it's 220 million iPhones there. 130 million have not upgraded in 4+ years. That growth opportunity will be on the horizon. I think Thursday, it's really about Apple showing that growth as you go into the June quarter, September, what we're seeing in China, that turnaround's there. And this all sets up for AI coming to Cupertino.
Here's the latest this morning. Amazon earnings due tomorrow, Apple Thursday, following strong numbers from Microsoft and Alphabet. The latest results helping stocks record their best week of gains this year and sending a clear message to investors. AI spending is paying off. Ed Ludlow joins us now for more to look ahead to what's happening in technology ahead of his programme with Caroline Hyde a little bit later this morning. Ed, dominating the story this morning, it's not Amazon, it's not Apple. It's right here with Tesla up in a pre-market by close to 13% following that surprise visit to China from Elon Musk. Ed, what was your reaction to that?
It's just a crucial step in the plan that Musk outlined for full self-driving or this autonomous future. You know, I heard you talking to your guest earlier about there are some CEOs that do China well and some that don't. And Elon Musk has always had a relationship with China, frankly, as a good base starting line. It's become a bit more complicated in recent years, but Premier Li Cheng, who he met with Sunday, was one of the kind of leading officials when Tesla wanted to set up Shanghai in the first place. And his ability to go there and unlock that key step, a tentative or prelim approval, it serves them in the short term because they can unlock software revenues, much higher margin, in what's a competitive market for driver assistance technology, but long term it feeds into what is now the sole thesis for many, which is robotaxi and autonomy.
Ed, who's actually got the IP here? That's what I want to get into. Typically when we talk about a partnership, a US firm or an international firm going into China, pushed into a partnership, often would be asking questions about the Western firm sacrificing IP. Who has the IP here?
For me, actually, this is the key question. And to answer your last question, this is the big takeaway. So it's a partnership with Baidu, according to Bloomberg's reporting, for in-car mapping and navigation, specific to that market. And the reason that's interesting is Tesla has actually used Baidu in China since 2020. You know, the car's ability to read the world around it is localized, right? You have 8 onboard cameras, and the algorithm or the artificial intelligence that powers FSD is trained on that camera data, but in combination with the map that you're navigating against. And so in this instance, Baidu has become an even deeper stakeholder in Tesla's future in that market. And I think you'll see that Baidu's ADRs at least are up in pre-market as well.
So they're using Baidu's technology, but where does the data get stored?
Well, this is the other key development overnight, that there are many hurdles that Tesla would have to pass. One of them is getting the regulators' green light on their data practices. You know, I mentioned Musk's success in China and his relationship with the country's government, but actually the data issue is still sensitive. So, for example, Teslas cannot be in close proximity to Chinese military facilities because of the cameras around the car and the concern that they're capturing data. The approval that Tesla got overnight is that regulators basically buy the idea that a consumer and I guess another entity that has the power to can switch off the car's ability to gather data if they feel that that's what they want to do. But I guess that was a key concern. If there was ever an idea that, well, when's Tesla going to do this? The Baidu piece is interesting, the relationship is interesting, but this data approval is probably the bigger milestone in this instance.
Does this then leapfrog them on top of everybody else on the EV space in China, and or is there anybody who's working on a similar set of abilities to do this? Or is this one of those ways where I've just jumped over the competition and therefore I can reap the benefits of that for some period of time?
Good morning. Excellent question. I mean, in China, just as with the EV market more broadly, the market for advanced driver assistance is also more developed and there's more choice. There are many more players. XPeng and Xiaomi market this very heavily. You know, in North America, you look at General Motors and Ford, which has its own issues with regulators this morning, are offering more limited versions of a driver assistance tool. but it's more saturated. And it goes back to the idea of, well, why is Baidu on the mapping side important? There are actually 20 potential partners in China Tesla could have gone to for mapping. So they're actually reinforcing an existing relationship. But yes, it's competitive, and there's no guarantee that they'll suddenly start selling these $8,000 packages or have incremental subscription revenue in the same way that they've been able to capture it here in the US.
Did they lock up Baidu so that it can only be working with Tesla and not with some of these other players? Or is this one of those things where they said, we're going to take the biggest player in here and we're going to put it together with Tesla and we are going to then become a juggernaut, and too bad for the rest of you because you're not going to be able to catch up?
Good question, Sarah. I'm good. I'm not that good. I don't know about the exclusivity of Baidu and Tesla's relationship. But one thing I would flag is that basically, think of this as in the bigger picture. Tesla knows it has to gather lots of miles to train its more promising neural nets. What I reported last week is there is a very top secret small batch of future generations of the underlying large language model that they hope will power a robotaxi. Tesla has 1.7 million vehicles sold in China. So those miles driven under this arrangement, no matter whether they're exclusive or not, will add great value to the longer term goal.
Self-driving really spooks regulators stateside, Ed. This is what we got just moments ago from AP, that the US is probing crashes involving Ford's automated driving system. Ed, could you comment on that, how difficult and complex things are for some of the US manufacturers trying to ultimately deal with the same technology and roll it out a whole lot more quickly?
Yeah, I mean, this relates to Ford's Blue Cruise, right, which is, as I kind of outlined earlier, it's a more limited advanced driver assistance tool. You know, Ford and General Motors have been much more careful not to market it as true autonomy. And yet, you know, NHTSA and other regulators still take a very close look. There have been incidents, right? You know, we're talking, think of all the people driving every day here in America. I think in Ford's case, we're talking about 20 or so situations that occurred, or accidents. That's how high the bar is. You know, how many people drive every day in a Ford, and 20 or so lead to serious looks by the regulator. It's very tough. And then, you know, as you know full well, John, Ford's got some other problems in its structure and its transition to EV that it's dealing with at the same time.
Yeah, that's for sure. Perhaps handling them better than others, though. Ed, let's look ahead to next week together. The next week, we've got Amazon tomorrow, Apple on Thursday. For you and Caroline throughout this week, what's the big focus going to be for you and the team?
Yeah, the bar's really high for Amazon now, or there's a lot of pressure on Amazon. You know, what we learned from Google and Microsoft, the number 2 and 3 in the market, is not just that there is actually some growth being juiced out from AI, but actually spending broadly on cloud has been quite good. So if you take the Microsoft example, 31% top line growth in Azure, they gave us a tangible 7% contribution within that 31 was specifically from AI. But that also means that you have 24% growth coming just from corporate spending on cloud. And whether Amazon, which is the clear market leader, AWS in cloud, gives us the same is important. You know, because then you'll learn whether or not they're holding market share or ceding market share to those names. But that's kind of the big story for them. AI now shows up in the financials. Good. We've been talking about it for quite a long time until that was the case. And then on Apple, I think, you know, we know it's a China iPhone story.
Big time. Ed, thank you, buddy. Looking forward to catching up with you through the week. Ed Ludlow there of Bloomberg Technology. Look out for Ed alongside Caroline at 11 a.m. Eastern Time on Bloomberg TV. Equities right now positive by 1/3%. Let's get that graphic up again. The week ahead in US markets, in fact global markets, we're looking for two big tech names, Amazon and Apple, the Federal Reserve sandwiched in between, and the cherry on top is payrolls on Friday. Sarah Hunt of Alpine Saxon Woods with us through the last 50 minutes or so. Sarah, just a final word on that. If you could take your pick right now, the data, the Fed decision, or the earnings, what would you take?
The earnings.
Why so important?
Because I think that the market has already started to game out the Fed decision. They've already started taking rates off the table. And I think that somebody made the point earlier this morning that we're already possibly even thinking about no cuts at all, at least quietly, if not in the WIR situation. And I think that the data has been mixed enough that anybody could pick and choose the right data that could, whatever thesis they had, they could have it. Earnings are earnings, and cash is cash. And so that is what people are looking at to say, okay, you've had these big valuation moves, you've had these big multiple moves. Am I keeping up with that on the earnings and on that cash generation. And I think that is critical. And if companies can continue to do that, then I think there's less vulnerability. It's when that starts to slip that you see more vulnerability.
Sarah, I've loved this. It's been great to catch up. We'll do it again soon. Sarah Hunt there of Alpine, Saxton Woods. Big week ahead, going into the opening bell about 35 minutes away. Equity futures are positive here by, let's call it a third of 1% to be generous after a big week of gains last week. We're adding a little bit of weight to it in the market this morning. In the bond market, yields are steady compared to what we have seen through the month of April. On a 10-year, we're down by about 3 basis points, 4.63. Tomorrow, Bramo will be back. This is the lineup for you. Former Fed economist Claudia Sahm, BlackRock's Amanda Lynham, Ron Temple of Lazard, and Citi's Rob Sockin alongside Anne-Marie's voice, making a comeback. Live from New York City. Have a fantastic week ahead. This was Bloomberg Surveillance.